Hi, everyone. Good morning. I just see Fahad's note. If everyone's okay with it, Fahad's wondering if we can introduce ourselves in the chat. No problem at all. Please feel free to introduce yourselves in the chat. We'd love to hear who's here with us. We have nearly 100 participants online already, so that might make our chat move a little bit, but do feel free to make use of that chat. And as we've just hit the hour, I'm going to get us started already. We have a lot of content to go through together today, and we're looking forward to spending the next 3.5 hours together with all of you. Before we get started, just to highlight that this workshop has been brought to you thanks to Boursa Kuwait, who is hosting us today. The content has been developed in partnership between the United Nations Sustainable Stock Exchanges Initiative, the IFC, which is part of the World Bank Group, and the IFRS Foundation. And we're very happy to continue this partnership today, also with Boursa Kuwait. Now, we're also very pleased to have Boursa Kuwait opening the webinar for us today. We have with us today Fatima Hashim, who is the ESG and Sustainability Assistant Manager at Boursa Kuwait. So Fatima has a long experience with ESG and knows a lot of these topics well, and we appreciate all the work that you've been doing, Fatima, to bring this knowledge to the market. And I'd love to pass over to you, Fatima, to kick us off for the workshop.
Good morning, everyone. So on behalf of Boursa Kuwait, I'd like to extend a warm welcome to all of you joining on today's training on the IFRS Sustainability Disclosure Standard. We are delighted to have you here for this important session that underscores our ongoing commitment to supporting listed companies in meeting global sustainability standards. As a stock exchange, we recognize the growing importance of sustainability disclosures and driving market transparency, corporate responsibility, and investor confidence. So this training is a crucial step in equipping our market participants with the knowledge and tools to actively navigate the evolving landscape of ESG and sustainability reporting. We are actively now promoting ESG principles across the markets, and today's session is one of initiatives that we have undertaking to ensure that companies not only understand the regulatory requirements, but also prepared to integrate sustainability into their core business practices. And by aligning with global standards like the IFRS sustainability disclosures, we are working together to strengthen our markets resilience and long-term sustainability. So I encourage all participants to engage in this workshop, ask questions, take advantage of the valuable expertise being shared today. And your active participation is key to making the most of this learning opportunity. Thank you once again for joining us, and I look forward to have a productive and insightful session.
Great. Thanks so much, Fatima. And thank you to you and your team for all the work in bringing this workshop to your market. It seems there was a lot of interest in the market for this topic. So let's dive straight in. Just a few housekeeping issues before we get started. First and foremost, you might notice that all of you are actually muted right now, so we can't hear you, but we would like to hear from you. So the best way to communicate with us is either through the chat function or the Q&A box. Now, the chat function, as you might be seeing now, it fills up very quickly and it moves very quickly. So it's difficult for all of our facilitators to catch your questions in the chat. So use that chat box for comments, to discuss with other participants anything you might wish, and of course, to introduce yourselves. But then any questions that you have, please put those in the Q&A box. So that double speech bubble there. That's the best way that we can interact back and forth with you, because we get a list of all the questions and they don't disappear until we answer them. So make sure that we can get to all of your questions that way. So a bit about today's workshop. So it is a full morning into the start of the afternoon for you. 3.5 hours will be together online, and we will give you a homework assignment during this workshop. That is, of course, a voluntary homework assignment. We won't ask you to submit it to us. However, that does help you to kind of bring together all the learnings, and we'll work through it also today in the workshop as time permits and help you to get a good start on that homework. But we highly recommend that you take a moment after this workshop, maybe today, maybe another day, and start thinking through that homework assignment so that you can really remember and bring together everything you learned in this 3.5 hours together. Now, as I mentioned, we do have that Q&A function in Zoom that we encourage you to use. And as Fatima also encouraged your active participation, please do ask any questions you have. We have with us today a number of experts here to answer your questions. So any questions are welcome. You can also see what other questions people are asking. And if they've already asked something that you want to know, go ahead and just upvote that. You can give a thumbs up, and that'll pop it to the top of our list as well. Now, we do expect you to participate, and the questions are not the only way you have to participate. We'll also be sharing with you something called Mentimeter. It's an online interactivity tool that'll allow you to answer questions and interact with us a little bit more. And we'll be having polls and quizzes throughout the training so that you can share with us kind of your current status and also test your learnings and see what you've been learning so far. And then to reward you for participation in this workshop, we will provide you with a certificate that is CPD certified by CPD UK. All we require is that you fill in a feedback survey at the end. So hang on to the very end. We will share with you a link to a feedback survey. Once you fill in that feedback survey, give us about 5 days and you'll get a certificate in your inbox. So a quick introduction to who we are. I'm coming from the United Nations Sustainable Stock Exchanges Initiative, and I lead our SSE Academy there, where we do a number of different training workshops like this one. My name's Tiffany Grabsky, very pleased to be with you today. I'm also joined with my colleague Lois Guthrie. Thanks for being with us today, Lois, who is our senior specialist and who has extensive knowledge in this area, previously being senior technical advisor to the IFRS Foundation and ISSB, as well as having extensive experience in sustainability reporting space with CDP, CDSB, integrated reporting, and the World Business Council for Sustainable Development. So thanks so much, Lois, for being with us today. We also have with us today our colleagues from the IFRS Foundation. So Bella Chang is a capacity building specialist, and she's a practitioner herself in the consulting field. So Bella brings with her a wealth of knowledge on this topic and a lot of technical understanding of the standards as well. We will be joined today also by Jarlath Malloy, who is Director of Strategic Affairs. And in addition to his work at the IFRS Foundation, where he is leading the capacity building program, and as well as its internal sustainability reporting, so he also has that practitioner hat on and knows what it's like to develop these reports as well. And we will be joined later on also by Relitsa Germanova, who is an ESG officer at the World Bank's IFC, or International Finance Corporation, who brings kind of that investor perspective. So hopefully we'll hear from her a bit later today. Now, we have a few objectives that all of us here presenting today have that we'd like to achieve with you today. So the 3 things we hope that you kind of take away and you achieve from this training session today is, first and foremost, we hope you leave understanding what are the ISSB standards. We also hope you understand then how to use the ISSB standards. And then finally, we're going to work with you to help you identify what steps you can take in order to develop a disclosure plan. Now, your company may already have a disclosure plan, it may not. You may know of it, you may not, but we're going to work with you through our homework exercise today to start to think about what that means to develop a disclosure plan and what benefits that can add for your organization. So to achieve those 3 objectives, we've broken down our training into 4 modules. So just to quickly overview what we're going to cover today, in module 1, which is our prepare module, we're going to look at what is the case for and the purpose of sustainability reporting. And we'll look at how the reporting landscape has evolved and how we've now reached the ISSB and their standards. Then in module 2, which is our align module, we really kind of look to set down the railroad tracks of direction. So once you understand the why, what tools are you going to use to make sure that you're heading in the right direction and achieving the objectives that you want with your sustainability disclosures? And we're going to focus today particularly on aligning to the global baseline and which we consider the IFRS S1 and S2, or the ISSB standards. But then we'll look at how you can also add additional disclosures onto that. That will bring us, a good portion through our training. We'll spend a lot of time on module 2, but then we'll go into module 3 and module 4, where we look at how to implement that, how to identify, evaluate, and integrate sustainability-related risks and opportunities, and finally, how to communicate this. And we mean where to communicate it, how to do this efficiently, and how to enhance confidence in your disclosures. So this is what our agenda looks like today. Just to note that, as I mentioned, module 2 is where the bulk of our efforts will go today, to make sure you really understand what are those standards and how you can make use of them. But then we will have a short break halfway through. It's just a 5-minute break. So hopefully you can stay with us the whole time. We have a lot of knowledge to impart. So we just had a little short break in the middle for you to do a quick stretch, maybe grab yourself a tea. We are also sharing with you a number of resources. So let me just introduce a few that we'll discuss quite a bit. First is the training materials. So Landon's going to share, if he hasn't already, in the chat box, a link to the web page where you can find already these training materials. So you can find the homework and you can find the slides already on our website. Thanks, Landon. So if you want to download those slides, that homework, you can do that at any time. In that homework assignment, as I had mentioned, what we're asking you to do is to develop a draft disclosure plan for your organization using what we've learned in this training program. Now, we will, after every module, do an activity together, as long as we have the time for that. And that's going to already get you started on your homework assignment. Now, this is not a mandatory requirement by any means. It's not mandatory for this training program, and it's not mandatory for the standards either. However, we think it's a very useful tool, which is why we're giving it to you as a homework assignment, to start to pull together your thoughts and thinking through the plan forward for your organization. Now, we also have developed a number of additional tools that might be useful for you, depending on where you are in this process and what you're working on. So for example, the first document you see there on the left-hand side is the model guidance on sustainability-related financial disclosures. And this model guidance was developed for stock exchanges, but it has almost all the content that we have in the training here today. So if you want to dig deeper, find more resources, read into this more thoroughly, you can make use of that model guidance document, which is on our website. Now, we also have some training tools that might be useful for you, such as our training tool on transition plans, or our training tool on disclosing climate-related metrics. Both of those deep dive into particular topics that we found people struggle with the most in our training. So we've developed a little bit more guidance on that for you. Now, the last one there, a gap analysis checklist. This is something we'll mention a few times. It's really a simplified version of the standards, so it does not replace the standards by any means. But if you want to start looking at where your disclosure is at and how you need to move forward, what might be missing, there's an easy to use checklist there that you can get started using just to do a gap analysis of your current disclosures. Now, that brings me to our Mentimeter. Now, I had mentioned at the very beginning that we did want to hear from you, and this was one of the tools we were going to be using. So you can see now a QR code on the bottom left of your screen. If you like, you can just take your phone and point to the camera there and open up in your browser this web page from the QR code, and that will bring you to this question. Now, that QR code is the same throughout our training today. So if you keep that open on your web browser in your phone or on your computer, whenever we change the slide on our side, you will get a new question on your side. So there's no need to kind of reopen it every time. The question you should get if you use that QR code, or if you use the link that's being shared in the chat box, or if you just type in www.menti.com, and use that code on the screen, 5254 4653. Pardon me. Then you'll get this question. In 3 words, tell us why you've joined today's training. Now, we have a good number of you on the call today, so I'm hoping we'll be able to get quite a few of you on the Menti. I see we have already over 200 participants on the webinar, so let's see how many of you we can get working the Menti. If you're struggling to access it, please let us know so we can help you, because we do want to hear from you. So we are seeing a few of you have managed to access so far. Knowledge seems to be the number one reason why you're here, but we also see compliance floating around in there. So that's often when we see a lot where companies are starting to realize that this is something being integrated into regulation and it's being required of companies, which obviously always makes companies nervous, but with compliance should always come education. So you're in the right spot to learn how to move forward with that. I see a lot of reporting, disclosure, things related to sharing information, and things related to learning, curiosity, learning, training, etc. So I think you're all in the right place. There's nothing on this list that we're not planning to tackle today. So I think that that's great. And we've got nearly 100 of you online now in the Menti. So let's move to the next question now that we've got quite a few of you being able to access it. So this is testing where you are now on those 3 objectives we had set. So how comfortable are you with these tasks? How comfortable are you in explaining to a team member what is the ISSB? So how is your understanding of the ISSB? How comfortable are you in using the ISSB standards? And finally, how comfortable are you already in developing a sustainability reporting strategy? Now, if you're not comfortable at all, choose strongly disagree or anywhere in between. And if you're very comfortable, strongly agree. And I'll give you just a moment to fill that in. It looks like currently we do have 1 or 2 participants that feel very comfortable with these topics. So that's great to see. And we do hope to hear from you in the chat and have you share your experience. The majority, however, are very uncomfortable with these topics. So I do hope that by the end of the session, you're feeling much more comfortable with all 3 of these topics and feeling ready to get started specifically on that last one in developing your disclosure strategy. Great. So I'll give just 5 more seconds to share your thoughts on that. Okay. Hasn't changed a ton, but great. Thanks. And it looks like we've got, a good, at least half of you that are comfortable using that Mentimeter. So that's good to see. Great. So with that, I'm going to now come to our first module, and we're going to dive really into the content and get to that learning that you've all said you're interested in, you're here for. Now, I will leave this disclaimer on just for a minute for you to review, but it's really just here to be clear as to how we are using the examples today. So they really are simply to help to add some color to what we're talking about. Sometimes it can help to see a real example to put into practice the discussion. However, the examples should not be seen as the best way or even the right way for your particular company. Remembering that each company has unique circumstances and it should do what best suits those circumstances. So you, however, can use these examples as inspiration to get started. Great. So our first module today is on prepare, which, as a reminder, is to help you to build a solid foundation of knowledge on this topic. And to do that, we have 3 key areas we're looking at. First, we're going to look at purpose, the case for and purpose of sustainability reporting, including the market and business case for sustainability reporting. Then we'll look at the landscape, so how the reporting landscape has evolved, including how it's been simplified over time. And then finally, the global baseline, so the core concepts and requirements in the IFRS S1 and S2 as the global baseline. So let's start first with purpose. And I'm going to start you off with another tool for interactivity. We're going to kick it off with a poll. So this isn't a quiz. We haven't really gotten into the content yet, but we want to hear from you. So what are your reasons for disclosing sustainability related information if you are already? So note that the last question, the last option is you're not already disclosing this information. So if you're not already, you can just choose that. But if you are disclosing at your organization some sustainability related information or ESG information, why is that? Is it due to regulatory requirements? Is it because your management has certain sustainability related objectives and you wish to share those objectives? Is it due to peer pressure or societal expectations? Is it for investor interest? Are you getting demand from investors? Or maybe there's another reason. And if there is, we'd love to hear from you. You can share that in the chat with us. Okay, so I'm going to wait till at least half of you fill in this poll. We're nearly there, actually. Everybody's very quick with their mouse this morning. Great, so we now have half of you. So I'm going to end the poll now. And you should be able to now see the results. So it looks like more than half of you, so 63% of you, are sharing information because of regulatory requirements, which is something we're seeing more and more now. But what's also very interesting to see here is that a number of you are also sharing information due to other reasons, such as sharing your management's objectives, peer pressure, investor interest, etc., which is what we want to see. So of course, as regulation is changing, more and more companies are going to have to share this information, and so will the companies in their value chain and their supply chain will have to be able to share certain information with those companies that they supply their products or services to. But if you really want to get the most out of this data, and if we want companies to be using this information for strategic decision-making processes, then we also want to see these other reasons too, such as societal expectations, which isn't just copying your peers, but it shows that certain stakeholder groups are particularly interested in this information and that it might have a material impact to them. Also sharing management's objectives, and of course, investor interest. Now, just as a reminder to everyone, the standards we're going to be talking about today do focus on investor interest and the investor demand. Great. So let's look a bit at that investor demand side. So you might be familiar with the UN Principles for Responsible Investment, the PRI. And as you can see here, there's been significant growth in membership of investors and asset managers and asset owners who are subscribing to these principles so that they are investing using responsible principles. So there's now more than 5,000 signatories representing more than 121 trillion US dollars in assets under management by signatories of these principles. So what I think is important to think about is not just that this is happening, but actually why this is happening. Why is the investor community so interested in this information? So I'll flag just here one study, although there's a lot more you could dive into on this topic. But I think this is an interesting study done by Morgan Stanley, looking particularly at retail investors, and where they found the driver of retail investors is having an interest in sustainable investing was actually quite simply financial performance. So we might think that it's being driven simply by regulation, by government objectives, by maybe the UN SDGs, by other areas such as this, which probably have an important role to play. But what's important to remember is that for investors, it does come back to that financial performance and really understanding a company's financial impact, a company's reaction to things changing around them, and their longevity, how long they're going to last, and when the next shock is going to impact that organization. So what do we mean when we're talking about effects on financial materiality or financial effects on companies? Or I think you'll hear a lot disclosing financially material sustainability related information. So we're going to discuss actually a lot in a lot more depth in this workshop, the word materiality and what material means, but we wanted to be clear from the start what sort of financial effects investors are really looking to have more information on. So let's start with the effects on a company's performance. Which is often seen in the statement of profit or loss, or showing where we show income or revenues and expenditures of a company. So sustainability-related risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company. If, for example, a demand for products and services are changing, or production capacity is disrupted, for example. We also could see substantial changes in expenditures if, for another example, operating costs increase due to energy prices increasing, or maybe a need for greater R&D, research and development expenditures to capitalize on sustainability-related opportunities or other costs associated with deploying new practices. Now, you will also hear us talk today about effects on a company's financial position. So let's look at what that means. We can often see a company's financial position on their balance sheet, also known as the statement of financial position. And so, for example, a company may experience changes to certain assets or liabilities due to climate or sustainability issues. And we might see changes in portfolio value, or we might even see write-offs of certain assets that are damaged, or maybe they need to be repriced. Another financial effect that should be documented is changes to financing and the cost of raising capital. That can include, for example, insurance premiums that increased due to climate risks, as well as maybe making use of new financing structures, such as using green bonds or social bonds. Now, before we move into the next unit of this module, I just wanted to flag two important aspects of sustainability-related opportunities. So this slide here comes from the World Economic Forum's Global Risk Report from 2024. And as you can see here, that something that may pose a significant risk 10 years from now actually might not be high on our mind today. It might not be something we're thinking about strategically. However, what's important for our disclosure is that if we're actually to be prepared for those risks or even opportunities that might arrive 5 to 10 years from now, we actually have to take action and often invest today in new practices or processes that mitigate or these negative impacts or increase our chances of positive impacts in the future, which means we may have, and in many cases should have, financial effects far before we might see the evolution of that risk or opportunity. So that changes a little bit what we've certainly thought of before in terms of our reporting, which often looks backwards in our finances, and helps us understand kind of the reasoning why we need to include today financial effects in our organization related to some sort of effect that we're expecting in the future, sometimes 5, 10, 15, or 20 years in the future. Now, another important aspect I wanted to cover about these risks, sustainability-related risks, and also opportunities is their interconnectivity, the connections between them. So this is also from the World Economic Forum's Global Risk Report. And as you can see here, there are many different connections between risks. And many people think of the two ISSB standards, IFRS S1 and S2, as being kind of two separate standards, which, would be kind of like taking these risks and separating them out and saying they don't actually have any connections between them. So let's just flag from the start that they aren't two different standards, that they actually work together. And that makes a lot of sense because you can't separate climate out from other sustainability risks, sustainability related risks and opportunities. So we're going to talk a lot about different types of connections and interconnectivity today, but just keeping in mind those two aspects of sustainability related risks and opportunities, the time factor and the connectivity factor, which will have a clear impact on our disclosure. Now, with that, let's look at the disclosure landscape, and I'm going to pass to my colleague Lois to take us through this. Over to you, Lois.
Thank you, Tiffany, and hello, everybody. Thanks for joining. So with Tiffany, we've looked at why we need sustainability disclosure standards because of the risks from sustainability and because of investor interest and so on. So now we're going to look at how the IFRS sustainability disclosure standards have developed within the landscape of existing reporting standards. Talking about existing reporting standards, we're going to start with a Zoom poll now to ask you if you could tell us what frameworks you are currently using for sustainability disclosure. So with this Zoom poll, you can make multiple choices. Please select all that apply. Are you using the Carbon Disclosure Project, CDP questionnaires, the Global Reporting Initiative, GRI, Integrated Reporting, Sustainability Accounting Standards Board standards, SASB, the Task Force on Climate-Related Financial Disclosures, or TCFD, the UN Global Compact or others. If you are using others, please let us know in the chat what you're using, because that will be very useful for us to know. I'll just give you a moment more to answer this question. Someone's saying that they use ESG raters criteria. Yes. Rating agencies, questionnaires. I think we'll thank you all very much. We can see a pattern emerging now. So we're going to end the poll and share the results. So you can see that the majority of people who have responded are using the Global Reporting Initiative standards, the GRI. The next most used framework is integrated reporting, then SASB, with some use of the TCFD recommendations, CDP and UNGC, the UN Global Compact. So thank you very much for sharing those results and for all the entries that you've put in the chat section. So let's move on now to to look at the IFRS Foundation and its structure. So the standards that we'll be looking at today have been developed by the IFRS Foundation. It's a not-for-profit public interest organisation that was established years ago to develop high-quality, understandable, enforceable and globally accepted accounting and now sustainability disclosure standards. So at the bottom of the slide, you'll see that there are two independent standard setting boards, the International Accounting Standards Board, or IASB, that was formed in 2001. They set standards for the preparation of financial statements, the financial position and performance statements that Tiffany was describing earlier. And these standards are in place in 140 jurisdictions around the world. The sister standards board is the International Sustainability Standards Board that was formed in 2021 and released its first two standards that we're going to be talking about today, IFRS 1 and 2, in 2023. And those standards were issued following strong market demand for the standards and for the establishment of the ISSB. Now that the IASB and IASB are in the same foundation, they work very closely together to ensure that their standards complement each other. The governance of the standard setting boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So let's look at how the IFRS standards evolved. Where did they come from? Well, on this screen, you'll see a number of logos with which you might be familiar. What they have in common is that all of these organizations and represented by the logos have contributed to the evolution of sustainability reporting. They actually have a lot in common, but sometimes their objectives differ, their guidelines and standards differ, and because of that, they have sometimes been described as an alphabet soup of reporting frameworks that has been described as giving some confusion in the market. Now, most of the organizations on the slide here focus on meeting investor needs for sustainability information, except GRI on the right-hand side there, which many of you use, and supports information for a broader range of stakeholders. Some of these organizations have been consolidated into the IFRS Foundation, and their work has been used to form the basis of IFRS sustainability disclosure standards. So the three at the bottom of the slide, the Climate Disclosure Standards Board, Integrated Reporting Framework, and SASB, their work has been consolidated into the IFRS Foundation. The standards were also very much built on the TCFD recommendations. So those of you that have been reporting in line with TCFD, you should find the IFRS standards very familiar. The TCFD has now effectively been abandoned or disbanded, should I say, and its work has been taken over by the IFRS Foundation, its work on climate change. On the right-hand side, you'll see CDP. CDP's climate questionnaire is now aligned with IFRS S2 on climate disclosure. And then on the left-hand side, we see TPT, which is the Transition Plan Task Force. And back in June, the IFRS Foundation announced that they will take over responsibility for disclosure-specific aspects of the Transition Plan Task Force work. So in a nutshell, what you can see here is that the landscape is being significantly simplified, and there's a lot of harmonization and simplification work going on, which we'll talk again about a little bit later. So having said that, let's do a little Zoom poll here. You can only select one answer to this question, either true or false. The question is, companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or is this false? Give you a moment to respond here. Very interesting results coming in. I'm going to wait till we've got 50% participation. We nearly have. There we are. So I'm going to end the poll now and share the results. Isn't this interesting? 50% of you said it's true and 50% said it's false. So really, as an audience here today, we don't know whether this is true or false. And that's perfectly understandable. The correct answer is false. But I can understand why people said true. Earlier in the last slide, we said that IFRS Foundation has based its work on the TCFD's recommendations, and it has, but there are some differences we'll look at in a moment. So although if you use the TCFD recommendations, you will be a really long way to conforming with the IFRS Foundations. There are some differences. So the correct answer is false. You cannot assume that if you use the TCFD recommendations, you automatically comply with all of the ISSB standards. So let's go on to look at these differences a little bit. There's a document that we've show you the thumbnail of on the left-hand side that's been issued by the IFRS Foundation, and it is a comparison between TCFD and IFRS S2 on climate-related disclosures. I'll just go through this briefly because not many of you are using TCFD. But basically what this tells us is that there are three types of differences. One is just a difference in wording, but to capture the same information. Two, the IFRS S2 does require a bit more detailed information than TCFD in some instances. So, for example, it asks for details about whether and how you intend to use carbon credits in order to meet your climate targets. And finally, there are some additional requirements and guidance in IFRS S2, including, as I've seen someone ask in the chat, reference to sector-specific standards that a company is required to consider. So, going back to the IFRS Foundation, one of its main objectives was to set a global baseline for sustainability disclosure. And the global baseline is designed to provide consistent and comparable sustainability disclosure across global capital markets. So the IFRS Foundation is working with jurisdictions around the world as well as with other stakeholders to achieve this. Now, on top of the global baseline, what is anticipated is that jurisdiction-specific requirements issued by regulators and others, and requirements that are designed to provide information for multi-stakeholder needs can be added to that global baseline as building blocks. So you can have additional disclosures on top of the global baseline that go beyond the remit of the ISSB. So this could include things like the GRI requirements or jurisdiction-specific information relevant to investors. So just the thing to remember from this slide is that the IFRS Foundation sets the global baseline. Regulators in jurisdictions can add requirements as building blocks to that, and requirements can be added to meet broader multi-stakeholder needs. So just very, very briefly, there is global backing for this global baseline and this global standard. The standard is the ISSB standards that were issued in June 2023, and we're going to talk about them later. IOSCO, which is the International Organization of Securities Commissions, they endorse the ISSB standards, and they've asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory frameworks. There is work going on with the IAASB, the International Auditing and Assurance Standards Board, on a new assurance standard to support sustainability disclosure. As part of its regulatory implementation program, the Foundation is supporting multiple jurisdictions with planning and preparation for voluntary and mandatory adoption of the standards. And of course, the Foundation, including through this program, is talking to stakeholders around the world who are planning to support voluntary disclosures against the new standards. So with that, I'm going to hand over to Bella, who will give us more detail about what's in the standards. Over to you, Bella.
Thanks, Lois. Yes, next slide. Well, yes, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. Okay, let's first look at a few terms. Oh, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrases sustainability-related financial information quite a lot. We are simply referring to a broad set of issues, including climate, nature, or biodiversity, social aspects, etc. Well, sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. Well, sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance or cost of capital, or in short, sustainability-related risks and opportunities that could affect the company's prospects. We will also often refer to the general purpose financial reports, which includes a company's financial statements and a management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use the generic phrase throughout. Anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. Okay, let's move to the standards IFRS S1 general requirements. There is a lot to understand, but you might be surprised that some of the detail is familiar. You will also see many of the conceptual foundations developed by the IASB in the ISSB standards. Let's now start with IFRS 1, or to give it its full title, General Requirements for Disclosure of Sustainability-Related Financial Information. This slide sets out key concepts in IFRS 1, and we will go through it all today. IFRS 1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities, and also identify material information. The SASB standards are organized by industry, enabling a company to identify sustainability-related disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. Now let's move to IFRS 2 for a high-level introduction. The scope of S1 is all sustainability topics except for climate, which is covered by S2. So the second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD. It sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And also it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risks, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers shall also refer to and consider the applicability of the industry-based guidance on implementing IFRS 2. This is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. Well, it's crucial that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS 1 and IFRS 2. This is because IFRS 1 sets out parameters for the type of the information that needs to be provided in order to be decision useful for investors. The fair presentation requirements require disclosure of relevant information about sustainability-related risks and opportunities, while the faithful representation requirements require complete, neutral, and accurate depiction of those risks and opportunities. You can find that IFRS 1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundations that underpin the SSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the SSB standards. To start with, one of the conceptual foundations is the requirement for a company to fairly present a complete set of sustainability-related risks and opportunities. Fair presentation requires disclosure of relevant information and is faithful representation. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept under IFRS 1 requires the organizational boundary for sustainability-related financial disclosures to be the same as for the financial statements. Another important concept is connected information. While we saw earlier when Tiffany explained how different risks are often interconnected, the standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and the connections between sustainability-related financial disclosures and the main financial statements. Well, now let's look at an example. So I'm going to hand over to Lois.
Thank you, Bella. So this is our first example. So we just need to remember what Tiffany told us at the beginning of the presentation, that these examples have a disclaimer attached to them and they're not intended to, they're not to be interpreted as best practice or the only practice, but they are useful in seeing how companies do things in real life. So this example is from BHP's annual report 2023, and BHP is a large mining company. And this example is used to show the connections they make between their decarbonisation strategy and other things. So they tell us at the top that the decarbonisation is embedded into their annual investment and prioritisation processes. So the first thing that they connect is the decarbonisation strategy with the investment process and decision making. So we can see that in the first paragraph, BHP says all investment decisions consider the quantity of GHG emissions associated with the project the cost per ton of CO2 equivalent associated with the project, and the alignment with the group pathways to a net zero trajectory. So investment decisions are therefore connected with the decarbonisation strategy and the group pathways to a net zero trajectory. The second thing that we see being connected in this example is that the decarbonisation strategy is connected with the various types of expenditure the company has now and in the future. So you can see how much was spent on operational GHG emissions reductions in the reporting year, and that was 122 million US dollars. You can also see what the company plans to spend until 2030, and that's 4 billion US dollars in paragraph 3 there. So that's the second connection: decarbonisation strategy and current and anticipated spending. The third connection is with the net present value. So the company says in the penultimate paragraph there that based on current assumptions, the achievement of medium-term targets from the decarbonisation strategy is expected to deliver positive net present value for the group, as it has done for already implemented projects. So 3 types of connections, and one other thing to notice here is that the company would already have had an investment decision process. So they've relied on something they already had, and they're using that to show a connection with their decarbonisation strategy. Very last thing to notice, the orange text right at the bottom of the page here is a navigation tool to tell us where we can find further information. So back to you, Bella.
Thanks, Lois. Okay, after the example, let's move on with another Zoom poll. Well, okay, let's test one of the core concepts now. The question is, what information should be considered for connected information? Connections between the 4 core content areas, or sustainability-related financial disclosures and the financial statements, or connections between sustainability-related risks and opportunities. This is a multiple choice, so you can select all the answers that you think right. Just to give a few more seconds. Okay, let me end the poll and share results. Just remember what I just said about connections. Well, that we should ensure that all of these 3 are connected. So the 3 answers are all right. Connections between the 4 core content areas and also the sustainability-related financial disclosure and the financial statements. Also, please remember that we need to ensure connections between sustainability-related risks and opportunities. Okay. Okay, let's move on. Okay. Finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then, others have followed, including the IFRS Knowledge Hub. We're also in the process of gathering examples and case studies provided by our partners. The SEPT standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated, with more planned to come. I should also note that the IFRS Foundation's capacity building program, which is launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so let's continue with another Zoom poll. Okay. So the question is, water is a vital input to our business, but the ISSB standards don't currently have a specific standard on water. What do you do? Just choose one answer that you think is right. Okay. Oh. Yes, half of us have answered this question. So I'm going to end the poll and share the results. Well, yes, I think most of us have answered this question correctly. The right answer is B. Vital is a vital input to your business, which means water-related information is material information to our sustainability-related financial disclosures. So the A is not right. Don't disclose anything about water. This is wrong. And B is the correct answer. But also maybe you will find option C and D maybe helpful. But for this question, the B is the correct answer. Okay, so now I'm going to hand over to Tiffany for the next slides.
Great. Thanks so much, Bella, for that great overview and getting us started with the standards. That actually brings us to the end of that first module. But before we wrap up, let's just take a few minutes to review what we covered. So first, we reviewed the purpose of sustainability-related disclosures, and a key takeaway that we hope you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related information. If you're not aiming to make good use of the data that you're collecting to improve your strategic decision-making, then you're going about this all wrong and potentially wasting your time. Also, if you have operations in difficult to abate or high impact sectors, your competitors could disclose these risks and identify opportunities they're pursuing, which leaves investors wondering why you're lagging behind, and that might also affect your ability to raise funds. So next, we looked at the evolution of disclosure standards and the formation of the ISSB and the aim to as the aim to simplify the landscape. So when you're thinking about other voluntary disclosures, you should not see the ISSB standards as competing with these other voluntary disclosures, but rather building those voluntary disclosures build on top of the standards. And then finally, we introduced the standards and important concepts that you need to understand in order to use the standards correctly. And as a key point, I just want to reiterate here that these standards and the guidance that comes with them are designed to meet the needs of investors and therefore are heavily focused on the prospects that we discussed at the very start of this unit, those financial effects that we were talking about. So with that now understood, hopefully by everyone, let's come back to that homework and do our first activity together. So in your homework slides, you will have an activity, the first activity, which is looking at really the people in your organization. So that activity asks you to answer the question, how will you build collective capacity and identify the responsible individuals for your disclosure? Now, we also gave you a few tips in the homework slide deck there. And we particularly recommended having a think about how you can make sure to get a good tone from the top. So really identifying who in your organization's board and C-suite will be responsible for oversight of sustainability related financial disclosures. And then also integration throughout the organization. So identifying what teams are already familiar with the evaluation and management of sustainability related risks and opportunities, and what teams will need additional capacity. And then negotiation. So working with colleagues and partners to build consensus on how, when, and by whom any necessary actions will be taken and monitored. So to get you started on that activity, let's go back to that Menti where I'm going to ask you, what will you do to identify the skills and knowledge gaps in your organization? So I'm going to bring us back here to this Mentimeter, and a few of you have already shared your answers with us. So as a reminder, you can use that QR code in the corner again, but if you already used it last time, you should just be able to go back to the browser you had open, and you should have this new question there if you haven't answered it already. But I am going to close out that QR code so we can see the answers. You can also access the Menti through the link that Landon's sharing in the chat. Or you can just type in www.menti.com and that code. And hopefully, I mean, we had nearly 100 of you in the Menti previously, so hopefully you have it open still on your web browser, so you could just go back to that and answer this question. So a few of the answers we have here are benchmarking the industry best practice. Sure, you might be able to do that, but I think you might first have to do things like what we see here, surveys and an assessment internally. So remember, in this one, we're thinking about the people in your organization. So you really need to think through kind of who in your organization maybe has these skills already and who needs more. We see here forming sustainability committees or partnering with academic institutions to stay current. A great idea. A sustainability committee certainly can help identify where those gaps are within your own organization and making sure that you're being able to identify the teams and the people who should be involved. We see collaboration with external consultants or sustainability experts can help align internal practices with industry standards, certainly. And often that's a first step if a company does have the resources that they can engage with an external consultant. And that external consultant can help them understand kind of what's lacking internally within the organization and help them to build that up. We see also here conduct a gap analysis or assessment. Accordingly, seek external expertise as well. Yeah, a gap analysis is very helpful. There's various different ways you can do that. We also see providing training programs. Yeah, so I mean, this is kind of a two-stage process to an extent. Once you identify that there are certain gaps in the knowledge of your staff or in the activities that teams perform, and that something's going to need to be built up, new capacities are going to need to be built, then training and education comes into play. So how are you going to start educating the staff? Are you going to encourage them to do workshops like this throughout the organization so that everybody has an understanding of how it impacts them? I think that'd be a great idea. We saw a few thumbs up to that. But also maybe kind of specific education for specific teams that need to upskill and specific training for that. So really great answers, everyone. It looks like everybody's, well on their way for this homework assignment. So we'll leave it at that. And I'll come back to the slides here. But I think that's all really good answers. So everybody already has, the first part of their homework nearly done already. Okay, so you should now be able to see that slide deck again. If you do lose the slide deck, just so you know, at the top of Zoom, sometimes you have two folders, kind of. One of them is just to look at the speakers, and the other one will show the slide deck. So if you lose it, you can go back that way in order to get back to it. Okay, so that actually brings us to our second module, which, as you remember, is the big chunk of what we're talking about today. And I'm going to pull Bella back, who's going to kick off this module for us. Thanks, Bella.
Thank you, Tiffany. Yes, let's continue with module 2. Now that we have introduced the initial concepts, let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. Okay. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures fit. To begin, let's focus first on how to apply the SSB standards as the global baseline. Let's get started on the first core content, governance. This includes aspects that relate to the governance body in your company and how management is applied. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. For example, is management responsibility delegated to a specific role or committee? And how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. Whether progress against these targets links to executive remunerations. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full SSB standards. Let's take a look at a couple examples of this to see what we mean in practice. So in next slide, we will see an example. Now I'm going to hand over to Lois.
Thank you, Bella. And this example is from the AIB Bank. It's a high street bank in Ireland with many sustainability credentials. And what we see on this slide is how the AIB has set up their governance model, including for sustainability. So we can see that there are 3 board committees: risk, audit, and sustainable business advisory. And each in turn is supported by an executive subcommittee and management. So this adopts the so-called 3 lines of defense model that you see illustrated in the diagram. So this is just one way of a company depicting the way that it manages sustainability issues at the board level. So this shows us the structure, but bear in mind there are many other models that a company can choose from. Now, this is an example from Toyota, a big car manufacturer, as you know, and it's based on their TCFD disclosures. So what's slightly different about this example compared to the other one, AIB Bank, they showed us the structure. In this example, we're looking at what the board does. So it tells us the role of the boards, yes, indeed. But in the last two bullet points is what I'd like to draw your attention to. So we see what the board has done to inform strategy in terms of climate change. So they have formulated a long-term strategy, including the Toyota Environmental Challenge 2050, and that is supported by medium to long-term targets and action plans that not only has the board formed as a strategy, but also monitors those targets and action plans. And then the very final paragraph in this extract, you can see the types of decisions that the board has made during their meeting. So they've reported and approved on the identification of carbon neutrality as a key matter in relation to climate change. And also they've resolved to invest in battery electric vehicles and to expand their line of battery electric vehicles. So with those two examples, one of structure, one of board action, I'll hand back to you, Bella. Oh no, to Tiffany, sorry, to you, Tiffany.
Thanks very much, Lois. So that gives us kind of an overview of the first category of governance. Hopefully those examples also make it a little clear for everybody. But let's look now at the next core content, which is strategy. Now, strategy has quite a few more disclosure to include than governance, but it's really where a company can see the benefits from sustainability related opportunities and be prepared for those risks. And as you can see here, there are kind of three high level areas that we focus on in the strategy content area, which are risks and opportunities, effects on an organization, so whether that be on the business model and supply chain, on its strategy or financial and cash flows, and finally on resilience. And we'll review each of these a little bit more in detail. So let's start with that first category, which was risks and opportunities. Now, just as a reminder, IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability related risks and opportunities. So if we first look at the requirements related to sustainability related risks and opportunities, these are some questions that you might want to be asking internally, which again, you can find kind of a more detailed summary in the SSE gap analysis checklist. So when disclosing information about risks, information required includes the description of the effects, the time horizon under which those effects are expected, keeping in mind that the financial effects can occur before the risk or opportunity materializes or even after, and this can change over time. And the last two questions on that list in particular, or at least, sorry, the last one in particular, looks really at climate, which is a requirement in S2. So if it is a climate-related risk, is it a physical or transition risks? So investors really want to understand what types of risks or opportunities we're seeing, and we often see them categorized by physical or transition risk. And you might remember those if you're familiar with TCFD, the Task Force on Climate-Related Financial Disclosures. Just to note also that both standards include guidance to support companies on identifying and disclosing risks and opportunities. So for example, using the industry-based guidance and SASB standards. And now this can often be a little bit easier to look at with an example. So let's look at this example here from Gold Fields, their integrated annual report, which was from 2023. Now, Gold Fields is a diversified gold producer. They have mines in South Africa and Australia, Ghana, Chile, and Peru. And in this extract on the slide, we can see which risks the company has identified, how they have identified them using a prioritization matrix, and how the risks align with strategic priorities and what mitigation policies the company is using. There is a lot more information about those risks throughout the report, but just to get you kind of started on this, it's one way that you can see that companies illustrate kind of how they've identified those effects and what effects they're seeing. Now, another aspect of the risks and opportunities identified as having a potential financial effect that will need to be disclosed brings us back to what I was discussing at the beginning, and that's time. So you may remember we discussed earlier that time, the time factor is something quite different when we're talking about sustainability related disclosures, or something new for many people. So let's make sure that we're quite clear on what we mean by time horizons here. So the standard does ask you to identify what time horizon or under what time horizon certain material effects are expected to occur. And definitions of short, medium, and long-term horizons actually vary between companies. And they depend on many factors, such as investment and business cycles, such as strategic planning horizons, or also the life of assets, and also various other factors. So I think what's important to note here when we're talking about time horizons is this isn't something that IFRS is defining for you. It's something that you should be defining as an organization. So don't expect investors to know what short and medium term means. You have to provide a quantitative definition and be clear as to what time horizons you've used. And the reasoning behind that should make sense based on what we just talked about, those investment cycles, the business cycles, strategic planning horizons, life of assets, etc. Now, let's move on to the second kind of high-level grouping of disclosures in the strategy category. So remember, given that the first section of strategy, that strategy component relates to identifying those risks and opportunities that could be reasonably expected to affect the company's prospects, it's, I think, quite natural that the next set of disclosures pertain to what exactly the effect is and where it occurs in the business. So to start talking about disclosure requirements of this area, you might want to start asking questions internally, such as you can see on this slide, beginning to describe these effects and understanding the response planned for mitigation or an adaptation for the effects identified from sustainability related risks and opportunities. So questions like, what are the current and anticipated effects of those risks that have been identified? What type of effects are expected? And where is that effect expected to take place? That might be where physically, globally, or it might be where in your business. And is the actual and planned response to the effect identified? Now, again, it's helpful sometimes, I think, to see this in an example. So let's look at this example from a global chemical producer in the 2023 annual report. Pardon me. So the company acknowledges here that their strategy is actually affected by a changing climate, as well as scarcity of natural resources and pressure on ecosystems and a growing population. And as we discussed in the first set of questions for strategy, they were able to show which risks and opportunities they expect to affect their company. But furthermore, they then explain these effects, and they say that their business, they're in the chemistry business, has a key role to play in addressing those challenges identified, including through innovation, through using raw materials more efficiently, through reducing waste and enabling healthy food production and climate smart mobility. Now, as well as the changes they hope that chemistry as an industry will offer society and the economy, the company itself will need to undergo profound changes as well in order to meet these needs. So these transformations within their company, as well as all throughout their value chain, are shown in this excerpt that we included on this slide here. where we see that the company's supply chain, its production, and its products will all have an effect. Great. So that brings us to one other aspect of disclosure, disclosing these effects. So sometimes one of the obstacles that companies face when reporting on the effects is to what detail this should be disclosed. So in the example we just looked at, we were showing mostly qualitative disclosures and descriptions. They did provide more throughout the report, but what we saw on the slide was just qualitative. But what about quantitative disclosures? Now, actually, a company is required to disclose both quantitative and qualitative, so numbers and descriptions about the current and anticipated financial effects of sustainability-related risks and opportunities. However, there are certain circumstances where the standard has set out criteria for when only a description or qualitative information is required. So, for example, if a company cannot separate the effects of climate-related risks or opportunities from other effects, if it's not clear kind of the distinction between the effects, or if it's very difficult to measure, if there's really high measurement uncertainty, then the standards permit the use of just qualitative information for current and anticipated financial effects. Now, also, if the company does not have the skills, the capabilities, and the resources to provide that quantitative information, then it's permitted for anticipated financial effects only that qualitative information or descriptive information can be used. Now, in your slide deck, you have one more example hidden. We have it. We're not showing it today, but you can go to the handout that you have to see another example there. But let's move on. Pardon me, to the last set of questions, the last components of the strategy content area. So the first part, remember, was looking at the risks and opportunities that are going to affect the reporting company. The second part was then looking at the effects. And now this final part of disclosures we're looking at is looking at how the company is prepared for uncertainties and ensuring its resilience into the future. Now, remember, we did talk a little bit about that in the last group. Here we're looking specifically at climate and what's provided in S2. And this really gets into practices and processes that a company has in place to assess its own resilience and to make strategic adjustments when needed. So disclosures include information on what type of assessment was used, and in particular, how a scenario analysis is used to assess climate resilience. And at the heart of it, resilience disclosure requirements really ask the company to disclose really how it assesses its resilience to climate and the inputs and key assumptions that are used in order to do that using a scenario analysis. So we're going to dive deeper into what is a scenario analysis a little bit later, but some questions you may want to consider asking internally when starting to disclose this information pertain to the company's capacity to react or adjust to uncertainties arising and how different scenarios are being used to test this resilience. So let's again come back to a couple examples here. Okay, so this one here is from Stora Enso, which is a Finnish and Swedish forestry company. So what we want to look at here is mostly that circle on the top right-hand side, actually. So Stora Enso distinguishes here between essential and growth business in this very, small yet quite powerful infographic. We don't have any numbers really in there, but we have an immediate picture of where growth is anticipated. And also detail about the company's long-term vision in the text there and their recent transition. And they describe this transition as, in quotes, proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring our future for many more years to come. So the company here gives a sense of how the growth business will expand through acquisition of other companies and converting machines and through innovation. So they're really painting a picture of how they're going to be resilient to shifts in their industry. Now, here's another example from Solvay, which is a Belgian multinational chemical company. And you can see here a little bit more about how they're using a scenario analysis and also getting financial effects from that. So in particular, I want to highlight how they are incredibly transparent here, which is what we want about the estimates, and note that they have been developed based on a scenario analysis, which was a tool that they used and described exactly how they were using it. So if you're using such a tool as a scenario analysis, which you should be, you need to explain how you're using it to investors. So you can see in this excerpt that they note what assumptions they've used, indicating that they used the scenario analysis tools from a leading consulting firm to identify those assumptions used for their assessment. And they also highlight that internal experts work together with that consultant to conduct this assessment. So if we take a look at maybe just one of the business units that they assessed here, we can see a bit more about how this process unfolded. So let's look at the soda ash business, that first one there. So soda ash is a key ingredient in everyday life. It's found in windows, in rechargeable batteries, in detergents, and many other products. And in the 1860s, Ernst Solvay invented the process to produce it, and it's actually the same process that's even used now. 160 years later, it's still the preferred process, but it's actually quite carbon intensive. So Solvay is developing new lower carbon ways of being able to develop soda ash. So the key headlines that they note from this assessment of that particular business unit using a scenario analysis is that although the cost of raw materials could impact their margin by around 16% in a 1.5 degree scenario, the increase in demand for example, through glass for high efficiency buildings is really likely to make up for this. So they do see that the increased costs will mean that they still make sufficient revenue by increased demand. However, they did see that this leads to a really great opportunity that if they can improve their processes and lessen that impact on their margin, that they can be increasingly more competitive vis-a-vis their peers and capture this increased demand because they can offer it at a lower cost. So that's why they're investing and working on creating new ways of developing soda ash. So that they can do it in a less carbon intensive way and decrease the costs that they're going to see in the future. And actually, they did find in all three of the business areas that they were looking into through the scenario analysis that they were going to see more opportunities than they were risks because they were already starting to work on these areas. Great. So with that example, now let's do another poll. Just going to quickly share this poll here. Great. So that should have popped up on your screen now. And it's saying, it's a little quiz and it's asking you, a company may choose to disclose only qualitative information or a combination. It's always welcome. In which of these certain circumstances? So remember a few slides earlier, I was discussing in which situations a company may be able to just provide a description. They might not include that quantitative information. So you can choose more than one. Can you omit quantitative information if the company cannot separate the effects of a climate-related risk or opportunity from other effects, or if there is a high level of measurement uncertainty? Or the third option there is the quantitative information might shed negative light on the company. I'll give you just a moment to fill that in. Okay, well done, everyone. I think many of you spotted the incorrect answer there. So the first two are correct indeed. And remember, the third thing that we considered there was in the situation where the company does not have the resources to be able to develop quantitative disclosures for future effects or anticipated effects, then qualitative disclosures can be used. But that last one, the quantitative information shedding negative light on a company, is not a reason to not disclose this information. Actually, it might be a reason that you do need to disclose it. So that third one was incorrect. Great. And so with that, that brings us to our next aspect here, which is the climate aspects of strategy. And Lois is going to take us through that. Thanks, Lois.
Thanks, Tiffany. Yes, so the content that we've looked at so far, governance and strategy, the requirements in S1 and S2 are quite similar. So for both S1 general requirements and S2, the strategy section asks you, what are your sustainability related risks and opportunities? What are their effects on your business model, the value chain, strategy and decision making, financial position performance and cash flows, and how resilient is your strategy to those risks? Well, all those same principles apply to climate, but there are some climate specific elements of them. So this slide is entitled From TCFD to ISSB because what we're trying to do here is to show you both the application of TCFD if you already use it, but also where the ISSB differs in its strategy disclosures. But if you don't know TCFD or don't use TCFD, don't worry, please just treat this list here as a list of things that you would need to consider in the climate IFRS S2 standard about your climate disclosures. So for strategy, the things to take account of are the fact that the S2 standard requires a company to refer to and consider the applicability of industry-based disclosure topics in the industry-based guidance that accompanies S2, and this is for the purpose of identifying climate-related risks and opportunities. Secondly, the standard requires that the company describes where in the business model and value chain the climate-related risks and opportunities are concentrated. So it might be geographically or in one of your facilities or in part of the business model. Where are they concentrated? Thirdly, S2 requires that a company reports on the effects of their climate-related risks and opportunities. So is there an effect that gives rise to a response in the company? So how will the company mitigate or adapt to any of those risks? What is the effect? Then the standard sets out the criteria for when you use quantitative and qualitative information for the disclosure of the current and anticipated financial effects of climate change. So disclosure of qualitative information is permitted under some circumstances, for example, where the company cannot separately identify the effect of the risk or opportunity on the finances, or where the level of measurement uncertainty is so high that it would make quantitative information not useful. The company is only required to use all reasonable and supportable information available to it at the reporting date without undue cost or effort, or use an approach that's commensurate with its specific circumstances. Now, this easement in the standard recognizes that some of these requirements are quite difficult to respond to, and therefore the reassurance is that the company only has to use reasonable and supportable information available to it at the reporting date. Tiffany mentioned earlier and showed some examples of companies using scenarios which they are required to do for assessing the resilience of the company's strategy to climate-related risks and opportunities. Now, S2 does not specify the particular scenarios that a company must use, but the general practice is, as we saw in the example from Solvay that Tiffany gave us, is to use a range of scenarios for assessing resilience. And finally, S2 requires additional information on the company's strategic resilience to climate-related risks and opportunities. But when giving that information, it should provide information about the significant areas of uncertainty the company has considered in its assessment. What is the company's capacity to adjust and adapt its strategy and business model over time? And of course, how and when the climate scenario analysis was carried out. So moving on now to another aspect of the strategy core components that is very specific to climate. IFRS S2 requires a company to disclose details of any climate-related transition plan it might have. Now, bear in mind that there's no requirement in the standard for a company to have a transition plan, but if it does, it needs to provide details of it. So let's briefly have a look at some of the resources that are available to support you with this. First of all, just to mention that transition plans are, sorry, I should have been on this slide. The transition plans are an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including things like greenhouse gas emissions reductions plans. So because the transition plan is an aspect of the overall strategy, the first bullet point we see here says that it should align with the company's strategy, business case, and business motivation. And within that, identify decarbonisation levers most economically and technologically feasible for the company to use in advancing its transition plan. Secondly, the transition plan should align with science. So what does science say about the transition? And this might include aligning your net zero pledges and climate neutrality goals with the Paris Agreement. Thirdly, the transition plan should set long-term goals with clear mitigation and adaptation activities and interim milestones to track progress towards those targets. So then next, the transition plan should be transparent about the dependencies, risks, and challenges of executing the transition plan. What are the things that are going to jeopardize its achievement, for example? And the company should also explain how residual and unabated greenhouse gas emissions will be treated. The transition, of course, will proceed in different ways for different sectors, and therefore sector-specific pathways should inform the development of the company's transition plan and what they say about it. And we're going to look at some resources to help with that in a moment. And then finally, the company should consider how the transition plan will be evaluated and therefore give it hallmarks of credibility so that the readers of the plan that are assessing its credibility will be able to see those hallmarks in the transition plan. So let's look now at the resources. We've had a peep at them already because I moved on to the wrong slide, and apologies for that. But what we see in the middle of the slide here are three resources that are offered by GFANZ, which is the Glasgow Financial Alliance for Net Zero. And these set out the expectations of transition plans for real economy companies, for financial institutions, but they also set out sectoral pathways for financial institutions that also give us insight into what the expectations are for companies in particular sectors. So we have a range of resources from GFANZ. On the right-hand side of the slide, you can see the Transition Plan Task Force's disclosure framework that actually has a lot of interesting guidance in it and a lot of documents that support this disclosure framework that give a lot more practical insight into developing a transition plan. So on the left-hand side of the screen, you see a pyramid with the IFRS Foundation at the bottom and GFANZ, the Glasgow Finance for the Financial Alliance for Net Zero next, and then the Transition Pathway Task Force. And this pyramid is designed to say that all of the guidance is meant to support and is built on top of the IFRS sustainability disclosures. So a key message here is that there is guidance to help you. There's a lot more than this, but that's as much as we can tell you in the time allotted. So you'll be really glad to hear that it's now time for us to take a break. We have a 5-minute break. We're going to play you some relaxing music, but please don't relax too much. Perhaps roll the shoulders a little bit, have a walk around, and we'll see you back here in 5 minutes. Hello, everybody. Welcome back. So we're going to move on to the third core content element of the IFRS sustainability disclosure standards now, and this is risk management. So as you can see from the high level little summary here, this category of disclosures requires report preparers to disclose information about their processes for risk management of sustainability-related risks and opportunities, and how they fit into the company's overall enterprise risk management or risk profile. So with the risk management core content area, let's dig into this a little bit deeper. As a reminder, in the strategy content area, we were asked to describe the risks and opportunities that could reasonably be expected to affect a company's prospects. In the risk management disclosures, the focus turns now to how the company identifies those material risks and how they assess the different risks and opportunities more broadly. So a company is asked about what processes and policies they've used to identify, assess, prioritize, and monitor risks and opportunities. So this might include knowing things about the inputs and parameters used for risk management, whether and how sustainability-related risks and opportunities are prioritized, what type of criteria are used for prioritization, so things like nature, likelihood, magnitude, other criteria perhaps, how the sustainability-related risks and opportunities are monitored, and whether processes have changed since the last reporting period. And finally, the company needs to disclose whether the risk processes that apply to sustainability-related risks and opportunities are integrated into the overall process. And you can see a summary of the requirements in the SSE's gap analysis checklist we link at the bottom of the slide. So, as with the strategy core component we just saw, there are specific requirements under risk management that apply to climate change. Let's have a look at some of these. So with S2, you need to provide details on the inputs that are used to identify and assess risks, on what type of scenarios have used, and any changes to risk management processes, as we saw. But S2 does require some additional information that is additional to what was asked in TCFD. So let's have a look at those in a bit more detail. Now, with climate-related risks, what we have is actually a definition of climate-related risks in S2 that is based on the TCFD's definition. So there are two types of climate-related risks, transition and physical. Transition risks arise from efforts to transition to a lower carbon economy, and they're in turn categorized as policy and legal risks, technology, market, and reputational risks. And we see some examples of those in the middle of the screen. So there could be risks associated with increased pricing of GHG emissions, more reporting obligations, exposure to litigation, cost of transition technologies, and so on. And in all cases, those risks can give rise to financial effects that affect the company's cash flows, access to finance, cost of capital, and these effects can manifest over different timeframes. Similarly, we have this definition of physical climate change risks that can be event-driven, and that is acute risks that arise from weather-related events, storms, floods, drought, and heat waves, unfortunately, we're seeing more of, or they can be chronic that are associated with longer-term shifts in climatic patterns giving rise to maybe sea level rise, reduced water availability and quality, biodiversity loss, changes in soil productivity. And again, we see some other examples in the middle of the screen and on the last column here, that they also, physical risks, can give rise to financial effects on the company. Similarly, in IFRS S2, climate-related opportunities are described, and they refer to the potential positive effects arising from climate change for a company. So these can take the shape of more resource efficiency, changing energy resource, developing products and services for new markets and to respond to consumer demand for lower carbon products, opportunities to participate in new markets and to improve the company's resilience. We see some examples in the middle of the slide, some of which I've described. And of course, these also can have effects on the company's finances, including their cash flows, access to finance, and cost of capital. And these financial effects can manifest under different time frames. So I'm going to hand over to Jarlath to take us through an example and then to lead us on to the final core content component. Thanks, Jarlath.
Thanks, Lois. Hello, everyone. Okay, so this example is from NATS, which is the UK air navigation service provider. It handles air traffic control in the UK and on the North Atlantic. Many of us will already know how bad weather causes delays for airlines and airports, and of course us as passengers. And this can often lead to increased CO2 emissions because of aircraft circling in holes or even being diverted if airspace becomes congested and inefficient. Climate change is driving increased frequency and severity of bad weather events. For example, summer thunderstorms and even turbulence, while on the ground extreme temperatures, flooding, winter storms all affect airports and the network infrastructure. However, long-term changes in the climate pattern may influence the jet stream, and that could shorten times for some intercontinental journeys. The disclosure here on the slide provides important details on how these risks have been assessed and how they've been deemed material to NATS's stakeholders. Building physical and operational resilience will need to be addressed in its strategy and in its long-term investment plans. So now we're going to spend some time reviewing the disclosure requirements on metrics and targets. This is the fourth core content area, and we'll start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they're absolute or relative, if they've been validated by a third party, as well as the methodology. So for example, what was the method of calculation? What were the inputs? Are there any limitations involved? What kind of assumptions were used? And so on. Now, let's flip to the second part, which is targets. Requirements on the targets area are designed to enable investors to understand the targets the company has set to monitor progress towards its achieving its strategic goals. The disclosure should include whether the targets are qualitative or quantitative, and whether they've been set voluntarily or if they're required by law or regulation in your jurisdiction. Now, disclosures should also on targets should include the metric used to set the target, as we said, and monitor progress towards its achievement. the baseline period from where progress is measured from, and the period to which the target applies. If that timeline is quite long, for example, in the case of greenhouse gas emissions, which we often see running out to 2050, there may be interim targets or milestones as part of those targets which have been set by the company, and they should be disclosed. And finally, if there have been any revisions to the target, that should be disclosed along with an explanation for those revisions for whatever reason they have been adopted. And Lois is going to take us through an example here.
Yes, thank you, Jarlath. This is an example from ArcelorMittal, which is a multinational steel manufacturing and mining corporation. And it's an example from their 2022 annual report. And this is an example of how they describe certain metrics and targets that they use. So at the start, we see that they have an ambition to have a leadership position within the steel industry and to achieve net zero steel making globally by 2050. So that sets the tone for what one might expect from their metrics and targets. The targets they set are to reduce intensity by 25% globally and 35% in Europe by 2030. So different targets globally and for Europe. They tell us the scope of the targets. So they cover scopes 1 and 2 greenhouse gas emissions for steel and mining per ton of crude steel. All of these targets are set within the roadmap that they set in 2021 for achieving medium-term 2030 CO2 equivalent targets. They also tell us what type of investment they anticipate to support these targets, and that's approximately $10 billion. They tell us in the right-hand columns or extracts the dependencies for the success of their ambition, including supportive regulatory frameworks and policy making, and they also tell us the assumptions behind their plans to deliver on these ambitions and targets. So quite a lot of information in a small extract for you to consider. And there's another example in your handout that you can have a look at your own leisure. And I'm now going to hand back to Jarlath to take us through climate-specific considerations on metrics and targets.
Thanks, Lois. So because there's only a small proportion of people today who have indicated they already use TCFD, we might just skip the next couple of slides. They'll be available in the pack, which you download anyway. And we'll just skip along then to GHG emission metrics, if that's okay. So questions on GHG emissions often come up in the context of metrics and targets. So we thought it might be helpful just to look at this very briefly. For anyone who's not familiar with the different types of scopes and this language, scope 1 includes all direct emissions that occur from sources which are either owned or controlled by your company. So for example, emissions from your company's facilities or vehicles. Scope 2 includes emissions from the generation generation of acquired and consumed electricity, steam, heat, and cooling. For example, obviously from the electricity purchase. And then scope 3 is all other indirect emissions that occur in your value chain, upstream and downstream. And so the reason we mention this is because S2 requires the company to disclose its absolute gross scope 1, scope 2, and scope 3 GHG emissions in accordance with the GHG protocol, the corporate standard, unless you're in a jurisdiction which requires you to use a different approach to measurement. And if you are using a different methodology, there is a transition relief to allow you to continue to using that in your first year of using the standard. One of the other disclosures is whether and how your company is using an internal price on carbon to support decision making. And finally, whether and how executive remuneration is linked to climate change. And we're going to bring Lois back in, I think, for another example.
Yes, thank you, Jarlath. This example is from a company called Enel, which is an Italian manufacturer and distributor of electricity and gas. And this is an example of how Enel reports their greenhouse gas emissions, but also how they disaggregate or break down information about their greenhouse gas emissions. Now, at the top of the screen, you can see the greenhouse gas emissions, the carbon footprint, broken down by the different scopes that Jarlath just described. So the direct, indirect, and indirect scope 3 emissions are broken down. The pale green bar shows us the 2021 results, and the dark green bar shows us the 2022 results. So as we look across, we can see first where the majority of greenhouse gas emissions are in scope 3, and second we can see the comparison year on year between 2021 and 2022, and we can see the total greenhouse gas emissions. Let's move to the bottom of the page where we see the breakdown of greenhouse gas emissions by source or business lines. So the business lines, generation, trading, networks, etc. You can see immediately from the graphs that the majority of scope 1 greenhouse gas emissions come from the generation of electricity from thermal sources, from the combustion of fuels in generation activities. The green bars tell us that the majority of emissions arise there and what the comparison is year on year. The little numbers you see just above the bars refer to notes that accompany this illustration. So note 1 tells us that the majority of emissions were from carbon dioxide, but there were also some emissions from methane, for example. And then we see some little dots next to those numbers, and the little dots tell us whether and to what extent the greenhouse gas source is considered within a science-based targets initiative target. So one little diagram that tells us a lot about Enel's greenhouse gas emissions and how they're broken down. Let's have a look at a Zoom poll now about metrics. You can select all that apply here. So we'll launch the Zoom poll, and the question is, what is the objective in the standards of the requirements on metrics? Is it to enable report users to understand the company's performance in relation to sustainability related risks and opportunities, to understand their progress towards targets, or to understand the company's assumptions for the future? We're filling in this one really fast. I'm going to wait till we get to 50%. Yes, we'll close there. Thank you. I'll share the results. So the majority of you said to understand the company's performance in relation to risks and opportunities, or to understand progress. Those that answered A and B are correct. In reality, the metrics might well help the readers understand the company's assumptions for the future. But the reason we ask you the question in this way, and the reason we really recommend that you read the standard, is that at the beginning of each of the core components, the standard sets out the objective of the core component. So in paragraph 45 of IFRS S1, the two objectives of the metrics requirements are A and B. C is not mentioned, but I wouldn't say that those that answered C are exactly wrong, because the metrics might well help investors to understand the company's assumptions for the future. So well done all of you, and encourage you to look at the standards, for the exact wording is quite important. So let's move on now to look at Just going on now to the final module in the Align section of our training today. We've covered all of the core content components that meet the ISSB standards, governance strategy, risk management metrics and targets. However, there are many of you on the line, I suspect, who will also have other information they need to report because of regulatory requirements or because of your stakeholder needs. So we're going to look at how you do that now. We described earlier the baseline, didn't we? The global baseline and the fact that you can have building blocks on top of that. So those building blocks might include things like any listing requirements that apply to you in your jurisdiction. And bear in mind that those requirements might also apply to, or you might ask your supply chain or value chain partners to give you information to support those types of requirements. You might build on the baseline because of policy objectives. You might be in a jurisdiction where governments offer incentives like tax cuts or subsidies for sustainable practices, or they might implement disincentives for activities that are counter to national objectives on sustainability. You might want to report something about that. Thirdly, you might need to provide additional disclosures, that is additional to the ISSB baseline, to align with emerging industry practices and to show how you're managing the sustainability-related risks and opportunities that are specific to your sector. And finally, as we've said, you might want to build on the baseline to provide information for stakeholders other than investors and to meet their information needs. Now, some of you have asked in the chat about jurisdictional adoption, and as you know, the ISSB standards become mandatory when and if a jurisdiction adopts them. So the ISSB tracks the progress of adoption and the discussions that are taking place in different jurisdictions, and you can see that on their website. We've given you the link there. But at the moment, more than 20 jurisdictions have committed to use or are taking steps to introduce the ISSB standards into their legal or regulatory frameworks. And together, those jurisdictions account for about 55% of global GDP. And the IFRS Foundation is supporting these jurisdictions in their regulatory implementation program. So there are, in addition to supporting regulators around the world, the IFRS Foundation works with organizations who already have disclosure frameworks to support what they describe as interoperability. So how the IFRS Foundation standards can work with the frameworks offered by others. So as we saw earlier, CDP has aligned their climate questionnaire with the IFRS Foundation's IFRS S2. S2 says that a company must use the greenhouse gas protocol to measure greenhouse gas emissions, and the ISSB is now actively engaged in governance arrangements with the GHG protocol team so that they can be involved in updates to the GHG protocol corporate standard. There's a memorandum of understanding with the GRI, and the two organisations seek to deliver full operability between their standards through jointly identifying and aligning common disclosures to deliver a seamless sustainability reporting programme. As we said earlier, the IFRS Foundation has taken over disclosure-specific aspects of the transition plan task force work. And some of you have asked about this too. The ISSB is considering how to build upon the work of the task force on nature-related financial disclosures as it considers development of biodiversity, ecosystem and ecosystem service standards in its future work plan. And we circulated the link to that in the chat earlier. Let's just say a little bit more about the ISSB and GRI, because we know many of you are using GRI. There's a document linked on the left-hand side of the page here, which shows the interoperability considerations between GRI and ISSB standards. This is a detailed mapping for where you use the two standards for disclosing scope 1, 2, and 3 greenhouse gas emissions. And there is a great deal of alignment between the two types of standards. And as we said, the two organisations are working in collaboration, including on biodiversity ecosystems and ecosystem services. Final thing to mention here is that the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. Now, the other thing to consider is interoperability between the European sustainability reporting standards that support the corporate sustainability sustainability directive and the IFRS standards. So the European standard setter for European sustainability reporting standards is called EFRAG, and they've been working closely with the ISSB to work on alignment of their respective standards and laws. So many companies are expected to choose or be required to apply both ESRS European standards and ISSB, and what the two organisations are doing is looking at how interoperable their work is. Now, what you see in the middle here is a conclusion that based on the climate-related disclosures of each organisation, there is a high degree of alignment between their two sets of standards. You can see at the bottom of the slide there that there's actually a guidance document you can look at if you need to know more about that. Then, of course, there were some of you we saw at the beginning of the session that are using integrated reporting. And the integrated reporting framework provides a principles-based guidance for reporting structure and content that complements IFRS S2. And of course, both the integrated reporting framework and ISSB standards designed to serve an audience of investors. So you see on the left-hand side here a really good guide to getting started on using integrated reporting to support your sustainability related financial disclosure in line with ISSB standards. And doing this, the integrated reporting framework can support this more holistic view of the value creation process and give you a way of providing a more complete picture of how value is created through your business model and strategy over time while meeting investor needs. This document provides a number of things that might help you, like some dedicated frequently asked questions, a mapping tool, and this guide to getting started. The final thing to notice here, to say here, is that, of course, the practice of integrated thinking is very important for sustainability disclosure, for strategic thinking, and it can certainly enhance the quality of a company's corporate governance as well. So I think we have another poll here. Yes, we do. We've talked about the different types of information you might disclose in addition to that required by the standards. So you can select as many answers as you need here. And this is my disclosure objectives should consider the ISSB standards only. Oh, sorry, it's single choice. You can only pick one. I beg your pardon. The ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above. Very quick participation here, and we can already see a pattern emerging. So I think in the interest of time, we'll end the poll and share the results. And you're all, you are mostly right, 72% of you are right, that in considering your disclosure objectives, you should take account of the ISSB standards, the regulatory requirements you're subject to, and other sources of guidance, because this gives you this complete and holistic sustainability-related disclosure. So well done to all of you for answering, or most of you for answering that question correctly. And I'm going to hand back to Tiffany.
Thank you very much, Lois, and thanks for wrapping up that second module, which was a big one, but hopefully everybody still took all that information in and is maybe chewing through it a little bit. Before we wrap up the module, let's just do a quick summary. So what we really looked at in this module was we were really reviewing the 4 core content areas of the ISSB standards: governance, strategy, risk management, and metrics and targets. But I think the important thing to remember here, the important takeaway, is that these 4 different categories of disclosures that we discuss certainly do not operate in silos or separately. So as we saw in our examples, that despite having 4 separate categories of disclosure, they all were very much interconnected. And in none of the examples did we see just one portion of the disclosures operating. We saw it all come together. Also, then we discussed, or at least Lois just talked us through how your disclosures might go beyond the requirements of S1, S2, for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or to meet industry standards. And we've seen a lot of questions related to this in the Q&A. So what's important to remember is that when you are doing this, adding those building blocks on top, make sure to keep in mind that indeed the ISSB standards have been purposefully developed for this, to act as that baseline and have a building blocks approach that allows report preparers to add those additional disclosures. But in doing so, it's really important that the report preparers are careful not to obscure then the requirements of S1 and S2. Now, let's take this opportunity to come back to your homework assignment. So the second activity that you'll find in your homework assignment is related to those particular disclosures that you want to address. So the first activity is looking at the people who are going to be responsible in the organization and who are going to be contributing to developing these disclosures. The second activity is looking at what exactly you are disclosing and what's missing. So we gave you a few tips to get you started on that in the homework. The first is to conduct a gap analysis. So determine what areas your organization is not yet communicating to investors on. And there is a simplified checklist. Actually, our checklist that we've been sharing in the link, the tool, I think everyone else can hear me, but someone says I cannot hear. If anyone cannot hear me, maybe one of the panelists can pipe up and say
We
something.
can hear you, Tiffany.
Okay, cool. I guess you wouldn't have heard that if you couldn't hear me. Sounds like everyone else can hear me. So sorry for the one person who's having trouble with sound. Hopefully in the chat we can figure that out with you. But yeah, make use of the checklist that we have available and the training and the tools that we've given you today to identify maybe what's missing, but then dig into those standards and look into exactly what might be missing in order to meet the requirements of the standards. Then from there, go on to look at what you need in addition to what the standards require, and kind of what's missing in those building blocks aspect of it. It's important that you identify what's missing because you can only start filling those gaps if you know what you're working towards. So let's do a quick little activity together. I'm going to come back to that Menti screen. So if you had that open in another window, you can go back to that and you'll have another question there if you haven't answered it already, which is what tools can you use to identify the gaps in sustainability-related financial information in your current disclosure? Again, we already have a lot of answers here, so I'm going to close out this so we can read them. But as a reminder, you can use the link in the chat, and you can use www.menti.com and that code at the top of your screen to access this. So the first response was sustainability reporting standards. Great start. And I might add the IFRS standards themselves. But also they did mention frameworks like GRI, SASB, TCFD, materiality assessments, evaluate what matters most to stakeholders. It's a really good start of identifying, of course, what material information you want to provide. And as a reminder, if you have been using TCFD or SASB, for example, those have been integrated into the IFRS Foundation. And there's great mapping documents for understanding moving from, for example, TCFD or GRI to achieving the requirements of the standards of S1 and S2. So make use of those mapping documents that we've shared in the chat. We also see here to identify gaps in sustainability related financial disclosures, I would use tools such as the IFRS Sustainability Disclosure Standards and the TCFD recommendations. Great, wonderful answer there. Gap analysis tools, relevant sustainability disclosure standards, consultancy tools. Yeah, so I think you all have a general sense that you need to use the standards. So I think that's quite good. But then you can use additional tools as well, of course. So yeah, consultants can help you to assess where you are now and where you need to move towards. Checklists also are kind of a quick first step often just to get your mind around it. Or if you just want to do kind of a yearly check-in and just make sure that you know, you've already worked on making sure you meet the standards, but just double checking those checklists can be very helpful. Let's see what else we see here. We see training pop up again. Yeah, so I mean, that was a bit of an obvious one when we're talking about people, but also in terms of what we're disclosing and what's being included in our disclosures. We've been talking a little bit, and we'll talk more about that later, about materiality. But indeed, if we're going to discuss kind of what are the risks and opportunities facing our organization and what effects these sustainability related risks and opportunities have in our organization, we might need to build up that capacity to be able to identify exactly what are those particular risks and opportunities we want to discuss, and making sure that those are included in our materiality assessment. Great. So a lot of really good answers here. We see look for automated tools. I mean, more and more we're getting, you know, the use of AI and different online tools we can use. But of course, you can't really replace looking at the standards and making sure that you're comparing to what the standards ask. Great. So I think you're well on your way, everyone, to be able to use these standards and start identifying what's missing in your disclosure, which is an important step to take in order to make sure that you're able to fill in those gaps. I'm going to come back to the slides here. And then we're going to go into our next module, module 3, and Lois is going to kick that off for us. So over to you, Lois.
Thanks, Tiffany. So in module 2, we looked at what you have to disclose. The ISSB as a standard setter, their job is to tell companies what to disclose. They don't necessarily, because it's not within their remit, explain how that should be done, how the disclosures should be made. So we're going to look at that a little bit, as much as we can in the time allotted, in our module on implementation. We're going to look at 3 things: how you identify sustainability related risks and opportunities, what sort of evaluation processes might be needed in the company to make decisions where there's a bit of uncertainty about the how aspect, how you can evaluate how to do things, and thirdly, how to integrate sustainability related financial information disclosure practices into your existing processes and practices. So let's move on to the first part of that, which is identifying sustainability related risks and opportunities. So IFRS S1, as we know, asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And IFRS S2 sets out the details for climate related disclosures. But what about risks and opportunities beyond climate? S1 directs companies, say you've got risks that are related to human rights or social issues, the local communities, biodiversity, ecosystems, water, etc. What should you do? Because there is no standard to tell you at the moment how to make disclosures on those. Well, S1 directs companies to sources of guidance that can be used to support the identification of those risks and opportunities, and to disclose, and what information to disclose about those other risks and opportunities. First, which risks and opportunities. So when identifying which risks and opportunities to report beyond climate, S1 says that the consideration must be given, so a company shall consider the SASB standards, and these can all be found, they're all linked from the ISSB website. And in addition, companies may consider other materials, industry practice, and the work of investor-focused standard setters, including the CDSB framework application guidance on water biodiversity and social issues. So once a company has identified which sustainability risks and opportunities, in addition to climate, that they might want to provide information on, what should they say about them? Again, the standards say that the company shall consider the SASB standards. They may also consider, to the extent that they meet investor information needs, the SASB framework application guidance on water, biodiversity and social issues, industry practices, perhaps by your industry body, materials of investor-focused standard setters, and the GRI standards and European sustainability reporting standards, as we've mentioned. So let's have a look at an example now of how a company has had a look at identifying their risks and opportunities. So this is an example from Yara's Integrated Report 2022, and Yara is an international global crop nutrition company. So at the top of the slide, we see that Yara has looked at what are the global megatrends that inform and influence their own view of risks. And we saw Tiffany mentioned earlier, you might want to look at, for example, the World Economic Forum's annual risk report to get an idea of what these global megatrends are. Then when we look at the bottom of the screen, we can see that they've taken their assessment of global megatrends like changes in urban global population, geopolitical and trade uncertainty, and they've effectively translated them into the types of risks and opportunities that apply to their own organization. So I won't go into them in detail here, but you'll see that the risks that they perceive for their own organization include regulatory changes because of changing consumer demand for sustainable products, because of the need to optimize fertilization use, and possible changes in fertilizer demand. They see risks associated with physical climate change, of course, being in the agriculture industry. They see risks from changes in demand for their products, including fertilizers, and the competitive landscape could be disrupted. On the opportunity side, they point to the opportunities that come from perhaps the use of digital tools that can enable new market channels and reduce yield gaps because of farmer connectivity. So they use drones and satellites and so on to connect farmers here. They see opportunities from the mainstream adoption of clean ammonia and hydrogen that they produce. A greater focus on soil health, water use and biodiversity gives them opportunities to develop their products accordingly. So we'll have a look at another example, slightly different one here, about identification of opportunities and the potential implications of climate change for Nest. This is an extract from their 2023 report, and Nest is a company based in Finland that produces sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. The company uses science and technology to transform waste and other resources into renewable fuel and circular raw materials. So you can see that the implications for Nest are very much focused on the opportunities. This extract comes from the climate section of their annual report, and it shows how the company identifies both risks and opportunities under 3 different temperature scenarios: a 1.5, a 2, and a 2.5 to 3 degree scenario. That's in the last column, the compromised targets column. And they look over a time horizon till 2050. And the extract shows us an overall assessment of whether the scenario is positive or otherwise for the company and indicative financial effects. So because of their business model being focused on the development of renewable fuels and circular products, you can see that the greatest opportunities arise in the lowest temperature scenario, the net zero world, which depends on rapid and radical temperature reductions. So it's a snapshot really telling you how they assess their opportunities in different scenarios. Next, now, as we've said, we've already covered this, so I'm just going to whiz through it quickly, but we've said that some of the how-to of these standards is quite difficult. And the IFRS Foundation recognizes that. They know that this is a challenging exercise. They know it's difficult to identify sustainability-related risks and opportunities. So the standard says that in applying specific requirements, and this does apply to the identification of risks and opportunities, the company is required to use only reasonable and supportable information available to it at the reporting date without undue cost and effort. We've already talked about that. So what do we mean by reasonable and supportable? Well, it's information that is specific to the company, that it impacts the actual company. As we saw with Yara, they haven't just looked at global megatrends, they've actually had a look at what is specific to their company and what they do. It takes account of the external environment, so for example, how regulation might change. It includes information about past events and current conditions that the company will already know, but also the company's forecasts and potential trends that it's noticed from the external environment. And in some cases, the standards do provide more specific information about certain types of risks. And the last thing to notice here is that these proportionality mechanisms say that preparers should use an approach that is commensurate with their skills, capabilities, and resources when applying certain requirements. And I think with that, it's over to you, Tiffany, for the evaluation part.
Indeed it is. Thanks very much, Lois. So once those risks and opportunities are identified, companies then, of course, need to evaluate the financial effect of those risks and opportunities. And this can often be the most daunting when first starting. So we will briefly review a few concepts that can be helpful when you're getting started on this. Now, to help investors understand a company's resilience specifically against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. It also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So you'll remember we looked at a few examples where we were discussing kind of the effects that we might see from either climate or sustainability related risks and opportunities. And a scenario analysis was a tool that we saw then that a lot of companies were using in those examples to be able to identify kind of how they will react to that and explain kind of as different scenarios might unfold, how they'll be able to survive in those certain situations. So for example, you might test your company's resilience against new regulation to limit certain high emission activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. So to do this, you can use scenarios based on science and analyze how these scenarios will lead to a company's incurring effects. It's important to remember that a scenario analysis does not require you to predict the future. It is a tool to test resilience in different futures. So we don't ever do just one scenario. That would be assuming that you already know the future and that's what's going to happen in the future. But we usually do multiple scenarios and look at how your company will be able to survive, I guess, in those different scenarios. So just to come back to S2 does not specify specifically which scenarios a company should use. in its analysis, but it does require a few things of the company. So it requires it to use relevant scenarios and provide information about the scenarios it has selected. It also provides the company to use information about other relevant assumptions that it's used in its scenario analysis. And S2 also includes guidance on how company can determine its approach to scenario analysis. And this encompasses a range of practice from qualitative scenario narratives to complex statistical modeling. So, considering all of this, it should be remembered that the ISSB standards do require a company to use an approach that's commensurate with the company's circumstances and to use all reasonable and supportable information that is available to the company at the reporting date without undue cost or effort. So let's maybe look at another example here. This one here is from Cemex, which is a Mexican multinational building materials company. They're active in over 50 countries around the world. And Cemex here uses a scenario analysis in its integrated report to illustrate how it combines this analysis with its assessment of progress against stated policies, SDG commitments, and its net zero targets. So this table, you can see, it has risks at the top half. In the bottom half, it has opportunities. And they also include in the page before this, it's not in our slides, but you can check out the report yourself. On the page before, they outline these 3 scenarios that were used, including the source, the temperature range and reference temperature, as well as the main assumptions for each scenario. As we've been discussing, all those details we need to know. So remember, when you are using a tool like a scenario analysis, keep in mind that you need to illustrate kind of what you did in that process. I think what's interesting about this disclosure example is that overall, like we saw in a couple previous examples, they've identified by using these different scenarios that opportunities in all future scenarios actually outweigh the risks to their business. Also, it's really important to make sure that all of your commitments, your policies, your practices all make sense and align. So we can see quite clearly here that the company's SDG alignment, its net zero targets, and its risk management are all working together, not against each other. And this also prevents duplication of work. So a useful tool as you start assessing and evaluating those risks and looking at what that might look like in different futures. Now, anticipating the materiality of future events can also be particularly challenging. So to help you with this determination, IFRS S1 asks that you consider a number of issues to help you with your judgment. So you could think of this list here on the slide as identifying kind of the steps and information you need to come to your judgment on the effects and the evaluation of different risks and opportunities. So as we can see from this list, companies should be considering all low probability but high income or high impact events, and also any uncertainty related to the company's future cash flows should be evaluated, for example. And another important point here is the need to reassess at each reporting period. So just a quick starter on getting that evaluation moving. And now let's move on to integrate, and Lois will take you back through that. Thanks, Lois.
Thank you, Tiffany. So after identification and evaluation, the third concept we wanted to talk about in this unit is integration, and that is whether, to what extent, and how you might need to develop new processes to support sustainability disclosure, or whether you can use existing processes to help with your disclosures. So let's have a look at some of the considerations that management might need to take when they're assessing existing systems and determining whether they need some new systems or processes or adaptations. So we've already talked about the first thing, which is gap analysis, but this is a gap analysis that applies also to systems and processes you might be using and whether anything new is being developed. I'm sure many of you know there's all sorts of software and different tools being developed for sustainability disclosure, but actually in a recent report by a German institution that had looked at thousands of companies and the tools they used in Germany, they said that 80% of companies were using Excel for their materiality assessments. So is that system enough? That's the type of gap analysis you might want to undertake. Also, how suitable is the existing process for identifying sustainability-related risks and opportunities? And are the prioritization criteria suitable for sustainability? As we know, sustainability-related risks and opportunities are uncertain. They manifest over different timeframes. We can't quite tell what their effect will be in any given place or at any given time. So do we need more prioritization criteria or different ones? So you might consider, in addition to probability and likelihood, prioritization criteria associated with impact, vulnerability, and speed of onset. Next, let's look at controls. Is there an internal control process that could be used, and is it suitable for the type of controls that may need to apply to sustainability-related information? Next, contributors. Who or which departments have relevant processes and expertise to contribute to your sustainability disclosures? This same German report I referred to earlier, they had a look across the different companies that they'd analysed at which departments were involved in the process. They found the main one 100% of the time, of course, the sustainability department, but next in equal place, the HR and accounting departments were involved in materiality assessment to support sustainability disclosure. They also identify the health and safety department being involved, investor relations, the procurement team, legal, strategy, risk management, facility management, and others. So there could be lots of contributors that would need to be involved with their systems and processes to contribute to sustainability disclosure. Then what are the interconnections between these different factors that influence sustainability disclosure, both internal and external? What are the uncertainties associated with the risks and opportunities, and how are they going to be managed? How will those uncertainties be managed with associated assumptions and so on? And finally, what might you need to manage existing, what resources might you need to manage existing processes or develop new systems and processes? Might there need to be an application for budget or a change management process? We've linked you there to a document from the World Business Council for Sustainable Development that might help you. Now, Tiffany's already mentioned the homework, which is to develop a disclosure strategy. And we are suggesting here that it might be helpful as an implementation part of your work to develop a disclosure plan. Now, this can be a standalone strategy, just looking at sustainability disclosure, or part of a wider strategy on disclosure that takes account of other forms of corporate reporting on governance and finance, for example. A disclosure plan enables you to take control of your narrative. Of course, your narrative must comply with any standards and regulations that you're required to conform with, but many of these standards, as we've seen, ask about your strategy, your governance metrics, your governance processes, the metrics you've decided to use to track your progress. So the plan helps you to sort of track and take control of that narrative. It supports internal collaboration and knowledge sharing across all the functions that I've just mentioned in the last slide. And most importantly, in my opinion, it creates a reference point, evidence, and an audit trail that explains who is involved, where and how judgments have been made. Effectively, it's like a permanent record of how you prepare your disclosures and can be turned to when you start a new reporting year so that you know how you did it last year and you can compare the two. So companies are actually in the process of disclosing their disclosure plans. They call them different things. Sometimes they can be called a data book, and that's what has happened in this example. This is an example from Hammerson, which is a British property developer. And what they're doing here in their data book extract is showing the basis on which they've prepared their reporting. I won't go into it in detail, but you can see right at the start, they tell us what period their report covers. They tell us in here what sort of standards that they've used for the preparation of their disclosures. They tell us about how they collect data and how they verify it. They tell us all sorts of other contextual information about how they have prepared their disclosures. So this really supports what we see in their public disclosures. There are many different ways in which this can be done. So let's have a poll, quick Zoom poll now, just to test our knowledge about disclosure plans. You can select one answer only here, and the question is a disclosure plan required by the IFRS sustainability disclosure standards? You can answer either yes, and you must disclose your plan, or no, it's not required, but it's a very helpful tool. So we'll just give you a few more minutes to complete this until we see a pattern emerge. Yes, I think we've got nearly 50% participation and we see a pattern. So I'm just going to share the results with you, and you can see that 53% of you said no, but it's a helpful tool, and 47% said yes. It's got quite another split opinion here, like we saw with an earlier question. The correct answer is no. There is nothing in the IFRS sustainability disclosure standards that says reporting entities are required to develop a disclosure plan and to disclose details about it. There is no such requirement. We've just suggested it here as part of your homework and showed some examples about it because, of course, it's a useful tool both for the company and for readers of your report to understand the basis on which you've done something to show your homework. So it's not a requirement to have a disclosure plan, but it might be helpful to disclose it for your readers. So well done to the majority of you that gave the correct answer no. Going to have a look at another little Zoom poll now. Here it is. So we've been through this, just testing how we listened. You can select all that apply here. This is multiple choice. A disclosure plan can help a company to take control of its narrative within general purpose financial reports, supports collaboration across different teams, acts as a reference point and audit trail for disclosure preparation, or can be used to skip full disclosure as prescribed by the ISSB. Again, very quick responses and a definite pattern emerging here. So I will end the poll and share the results. Yes, the majority of you are absolutely correct. All of the first three answers apply. The disclosure plan can help you take control of your narrative, to support collaboration across your different teams, and act as a reference point, an audit trail for disclosure preparation. It is not an excuse to skip full disclosure prescribed by the ISSB. So with that, I'm going to hand back to Tiffany to give us a summary of Module 3.
Great. Thanks so much, Lois, for wrapping up that module for us. And congratulations, everyone. That was our nearly second last module. So we're nearly at the final module here. But let's not move past that without reminding ourselves what we quickly discussed in that module. So in the last module, we wrapped up by highlighting the importance of connections between the 4 content areas of disclosure. And we then learned in this module that there are many connections as well between a company and its external and internal environment that need to be considered as well. So these connections are what we need to focus on to identify key risks and opportunities facing our organization. Now, the second thing we discussed in this module was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in the assumptions used. So using a scenario analysis can be a very helpful tool as it keeps track of those assumptions. And if you're new to this, a prepackaged scenario such as those from the NGFS can provide you with some of the assumptions that you can use and to get you started using a scenario analysis for the evaluation of those financial effects. And then finally, as we've seen, even if some of this data is not data you're already disclosing, you may already be collecting it for different reasons, or you may have the appropriate practices and processes in place to collect the data you want to report. You just need to make slight adjustments. So don't start from scratch. And that leads us on actually to our next activity. We're actually a little bit short on time, and I don't want to make Jarlath talk too quickly for the last unit. So I'm just going to discuss this activity. We won't have time to do it together, but you can do it on your own in your homework. So in the third activity, we in your homework outline something you want to discuss related to how you're collecting and managing data. And we give you a few tips in that homework about first thinking about identifying how you can collect the data that's not being collected. So remember, in the last activity, you were looking at the gaps in your disclosure, what was missing. Now you're looking at filling those gaps. So how are you going to do that? How are you going to collect that data and how are you going to manage it? But the key here is to think about what you're already doing and how you can repurpose maybe some of those practices and processes. So while we won't go to the Menti today because we're a little bit behind, what we want you to think about in that section of the homework activity is what existing systems and processes for data collection can already be adapted. And as you start thinking about this and honing in on the specific data that's missing in order to report that, you will often realize that you might actually be already recording some of that, but you're not disclosing it. So the gaps might seem bigger than they actually are because you might already have a lot of this information. Great. And so with that, let's take our last half an hour or so and do the final module. And Jarlath, thanks for joining us. Welcome. You've been answering a bunch of questions in the background, but we're happy to hear from you now. So over to you.
Thanks, Tiffany. Okay, so as Tiffany said, we're now into the last unit of the training, which focuses on the when and the where of disclosure of sustainability-related financial information. And just like the last unit, we have 3 main sections. And to get us started, we'll look at the location of these disclosures and where they should be placed. But before we get into the specific requirements, let's just think for a moment about the context of the reporting package that's useful to investors. We know investors already have access to a company's financial statements, and the ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. And these then all come together in a reporting package that we call General Purpose Financial Report. The requirements in the ISSB standards about what information to report are based on existing sustainability reporting regimes, focusing on investor information needs and on aspects of financial accounting standards. And those of you who are familiar with the IASB will understand this quite well. As we talked a little bit about this earlier, ISSB and GRI reporting standards share some content requirements, for example, what to report, but the ISSB standards are focused only on investors' information needs and decision making, and that reflects the mission of the IFRS Foundation, which is to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to defining materiality, but they're not competing definitions. The GRI approach is set out and understood among sustainability practitioners, and the IFRS approach is familiar to accountants and relies heavily on management judgment. A simple example of this is where a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they're important to disclose to investors. And as we just noted, materiality has different definitions for different reporting standards and audiences. So let's recap briefly what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. And once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. And this is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with the definition found in the IFRS accounting standards, the IASB standards. And as you can see on the screen, it's information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. Investors have asked for disclosure of material information, and the ISSB standards have been designed to help gather that information and help you disclose it. However, this means that a company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirement. So remember then to ensure material information is clearly identifiable and that you use plain language. Remember also to ensure material information is not scattered across your disclosure, and include any additional disclosures if they're required by regulators, but they're not material to investors. But include it, when you include it, ensure it is clearly identified as non-material. And then we're going to move on to, next we're going to move on to a poll. So unless it's been determined that the particular, oh sorry, pop up here. The question is, information should be disclosed in the annual report when applying the ISSB standards if, and you have three options, A, B, or C, and you can select more than one. Information should be disclosed in the annual report when applying the standards if omitting that information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the company's cash flows. And C, it exemplifies the values of the leadership team. So you can pick more than one option if you wish. I'm just going to give it another moment or two. Okay. Thank you very much. So we've got a clear pattern emerging there, A and B, and that is the correct answer. So unless it's been determined that the values from your leadership team are expected to have a financial effect on the company, and that might be true. This information is not necessary. Okay. So moving then on to where to report. Disclosure under the ISSB standards has to accompany the financial statements and be part of the same financial reporting package. We've said this now a couple of times, but S1 does not say where within that reporting package the information should be provided. And this is designed to allow for jurisdiction-specific requirements, and sometimes they exist on where particular information should be reported. And this also allows you to tell your own story in your own way, just as you do currently within your annual report. The most important factor to consider here is to ensure that sustainability disclosures are provided as part of the same reporting package as the company's financial statements. Sustainability disclosures must be provided at the same time as the financial statements, cover the same reporting period as the financial statements, and be authorized by the same body or individual authorizing the financial statements. Now, interestingly, research by WBCSD on integrated reporting last year showed that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, as we said, the ISSB standards require material sustainability information to be included in your annual report. And that seems to suggest that many companies have got a little bit of, quite a bit of work to do yet to prepare for adoption of the standards. And I'm going to pass back to Lois here for an example.
Thank you, Jarlath. I was just looking at the questions, so sorry for the slight delay. This is an example from a Philippines-based company, the Ayala Corporation, which is a conglomerate that has many activities, including property development, banks, healthcare, technology, and so on. And what you see on the page here is the way that they give a snapshot of what they're going to disclose in their integrated report. On the left-hand side, you see the inputs to their business model and their value creation mechanism from different forms of capital. In the middle, we see how they create value, and at the end, in the last column, we see the outputs, that is the value generated across different forms of capital as the integrated reporting framework describes them. Now, the reason we bring this to your attention is that this company has used the integrated reporting business models, the so-called octopus, showing tentacles in and out of the business, to give some navigation for its disclosures. So we can see from the arrows that we get page references to where we find more information across the report. And we can see that the report covers all types of disclosures, both ESG and business and financial, and risk management. So in one snapshot, we have a navigation tool for what's in the integrated report and how it relates to the company's business model. Back to you, Jarlath.
Thanks, Lois. Technology is an emerging consideration for disclosures. I think I saw a question on technology in the chat a few minutes ago. And some of you will know increasingly corporate reporting is moving from PDFs to web pages with structured data sets, such as those offered by a number of stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and the accompanying materials of the ISSB standards. So it doesn't introduce any new requirement. And a digital taxonomy is something which provides tags to make sustainability disclosures machine readable. And this makes it easier to take large data sets, for example, from an entire industry or even jurisdiction, and bring it together to analyze it. Digital reporting has a number of benefits. it makes the reported information easier to use for analysis because the data is structured using the same across the business in a machine readable format. Tagging information also allows for quality control for automated checks, and more data collection and management systems are compatible with digital reporting taxonomies, and that helps to improve processing and the preparation of reports. Of course, and quite obviously, tags can have labels and descriptions in multiple languages. So if you report quantitative data in one language, somebody speaking another language, an investor, for example, can understand what it means and run the analysis on it. Okay, that takes us then to the second part of this unit, on efficiency. So let's now think about how do we ensure efficient disclosures. And we've added this to the training because a common comment we find from companies is that they talk about a growing reporting burden. And what we're trying to do here is hopefully to highlight that if it's done correctly, efficiencies can be made to help reduce that burden. So first of all, it's important to understand what effective communication looks like and what's required. And some of you might have noticed over the years, companies sometimes think if they just put absolutely everything they've got onto a website, then they'll satisfy everyone. Perhaps they've gotten lots of supply chain requests and questionnaires, and they think let's just publish everything, and these people can find it there. And as appealing as that might sound, of course, it would be against one of the core concepts, particularly on fair presentation. So, for example, it could be helpful to ask these questions on the information that you are preparing and disclosing. Is it clear and concise? So in terms of clear, that might depend on the nature of the information. For example, whether it's clearer to present information in a table, a graph, a diagram with text. And then to be concise, disclosures need to avoid boilerplate information, unnecessary duplication of information, and to use clear language. Now, we're almost there. We're almost finished, and I'm wondering whether some of you are there watching the session today, and I wonder, are you thinking you still don't really see what all the fuss is about? And perhaps some of the preparers with us today have focused on standalone sustainability reports, or you might not have had too much interaction with audit or external audit over the years. Well, what I would say is, and particularly to the accountants watching, be kind to your colleagues. Help them understand the difference in rigor that's required in data collection, in oversight, in sign-off, etc., for a financial statement. And this means, for example, disclosures include comparative information and need to be restated. Disclosures avoid unnecessary duplication and cross-reference as required, and information must be material, must be connected and aggregated or disaggregated appropriately. Now, some of you might have already noticed there does appear to be some overlap in the disclosure topics. So, for example, you probably do have the same governance approach for all sustainability issues. And rather than duplicate this information, you can simply cross-reference where you talk about sustainability governance and climate change governance. You can simply cross-reference to enhance the efficiency of your disclosure. Cross-referencing to other reports is permitted as long as the report is available on the same terms and at the same time as the sustainability disclosure. And the cross-referenced information is assumed to become part of the overall reporting package. And of course, cross-referencing must be applied consistently and transparently. It should not result in information becoming more difficult to find or understand. And those now, I think, is going to take us through another example.
Yes, thanks, Jarlath. And oh, what's happened here? Can you see the slides?
Yeah, I see. I do.
Lois, try looking at the top of your screen. There might be two tabs.
Oh, yes, I do beg your pardon.
On one
Thank
of
you.
them.
Got it. Thanks, Tiffany and Jarlath.
All
Yes,
right.
this is an example from a company called CRH, which manufactures and supplies a wide range of products for the construction industry and is based in Ireland, like Jarlath is. And at the top of the page, we can see that this extract is about the impact of climate change and carbon emission reduction targets on the company's finances. So they are telling us at the top of the page that they have considered the impact of climate change in the financial statements. And in particular, they're looking at the impact of the climate-related risks and opportunities that they have identified and the reduction efforts that they're going to, and how these have been taken into account, if at all, in the financial statements. Right in the centre of this extract, under the title Climate Change and Carbon Emission Reduction Targets References, they're pointing here to the line items of the financial statements and giving us the page numbers where the financial statement line item may be found, so that they've been looking at whether their climate risks and opportunities affect their impairment testing of goodwill and property, plant and equipment, the useful lives of their assets, whether they need to make provisions for liabilities, inventories and retirement benefit obligations. So very specific about what they've looked at. Now, the thing to notice is that they tell us that having gone through the assessment of those line items, their conclusion is that there is no material impact on the financial statements as a result of the climate-related risks and opportunities that they have identified. They have applied their judgment to reach this conclusion, and their judgment has been applied using the company's accounting policies, estimates, and underlying assumptions. We know what they've looked at, we know where the lines are that they've looked at, but they tell us there's no material impact. So you might ask yourself, well, why is it that they're telling us this? And the reason is for completeness. They want to reassure the reader that as a high emitting industry in construction, and as they have identified sustainability related and climate related risks and opportunities, one might expect there to be an effect on the financial statements. They are reassuring us that they have considered that effect and that in their judgment there is no material impact. So quite a lot of information in one little extract there, Jarlath. Back to you.
Thanks, Lois. Okay. We've touched on a little bit of this before, but I want to just summarize it very briefly. And these are the mechanisms to support preparers get started with the standards that have been employed by the ISSB. So one very simple thing that was put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from the IASB, for example. Many of the requirements in S1 and S2 are to be applied proportionally, and you'll see phrases, the phrase all reasonable and supportable information without undue cost or effort. And Lois talked about this a little bit earlier on, and the other one was commensurate with the skills, capabilities, and resources. So there's quite a bit of flexibility built into the standards. And then on top of that, we've got the reliefs for the first year of application. So for example, companies are able to limit their disclosure to climate change in their first year, and then begin reporting on broader sustainability risks and opportunities in year 2. Companies can begin to provide their annual information with their next half year reporting rather than at the same time as the financial statements in the first year, so they get an extra 6 months. And companies don't need to provide scope 3 information in the first year. They don't need to apply the GHG protocol in the first year if they're using a different methodology. And obviously, they don't need to provide comparative information in the first year using S1 and S2. And another relief allows companies to include GHG emissions information from companies in their value chain who've got a different reporting cycle. And I think we've already mentioned a number of other sources of guidance and resources, including the SASB standards, the CDSB application guidance, among many others. So these releases are designed to help companies put in place reporting practices and structures to provide high quality decision useful information. And it will be hard. It'll be hard in the first year, like everything is, but over time it does get easier, and that's what's expected. Nobody's expecting perfection in the first year. You will get better. And a question that's popped up a couple of times already is that jurisdictions ultimately decide when to mandate adoption, but the standards are effective from the 1st of January this year, and we know many companies are preparing to adopt them voluntarily. I'm going to skip the poll just to make sure we finish on time, if that's okay. And the final element here is how we can ensure that users of financial reports have confidence in the data that you're disclosing. And one key element here is showing data and trends over time. And this is one of the reasons why the standards ask for comparatives, because they help provide context. They help to indicate progress, and that underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for calculating a metric. And in these situations, it is important for the company to revise the comparatives to enable investors to compare and analyze current figures with previous figures. And occasionally, companies' sustainability disclosures might contain material errors. And in this situation, it's required to restate these errors in the comparatives which have been previously provided. And of course, revisions or restatements are really only necessary when there's a risk that material information will be omitted, misstated, or obscured as a result of not revising or restating that information. Companies sometimes express concerns about sharing information they think is sensitive or could deplete their competitive advantage. The ISSB standards relieve a company from disclosing this information if it's commercially sensitive. And if this is a concern you have, there's more information you can read in the handout. Finally, then, if you have fulfilled all the requirements of the standards, you are required to issue or include a statement of compliance or conformance, even if you've used the release. And there's further information being published this week in Euroclimate Week on this topic. And you'll see a link to that on our website this week. Finally, then, this is the last thing I will say. Things to remember. I'm not going to read what's on the slide, but it's a little checklist to remember what you need to do. Ensure you have your information is material, amongst other things. Ensure investors can see the connections between risks and opportunities, the 4 content areas, and the sustainability and the financial statements. And of course, you need to make sure your information is consistent between the sustainability, risks and opportunities, and the financial statements. And that is me done. Tiffany, I'll pass to you to finish off with the summary.
Sounds great. Thanks so much, Charlotte. That was a lot packed into one module, so let's just quickly wrap it up with a summary again. So first, we discussed where to report information, and what was important here was the audience or who you are reporting to. So make sure to be clear from the start who's your primary user of information, and that will help you ensure that the information is the right information for their needs. Then we discussed briefly efficiency, and I think the key takeaway there is less is more. The objective is not to overload investors with information. Actually, that could be harmful, given it could obscure the information that is required. So using the standards as you get started can be a good guide to make sure you're providing what information investors need, which is, of course, the purpose of the ISSB standards. And then finally, we were discussing report user confidence. So especially in the current climate of greenwashing accusations and legal battles over public statements, you want to be totally sure that your data is not only accurate, but that it is presented in a way that builds confidence among report users. So the reporting plan that we've been discussing can help you to do this. As if it's done well, you'll then have a clear and documented process for reporting the data investors need. So that reporting plan is your homework. Again, sorry, we talked a little bit long on a few slides. We sometimes do get quite excited about this information. So we ran out of time for this last activity. But it is yours to work on now, and you both did, or you all did so well on the first two activities that I think you'll have no problem wrapping up this homework exercise. So you can look at that homework. Landon just shared in the chat the link. And for those of you who can't access the chat, you will also get emailed, and you have already been emailed by Zoom before the session, and you'll get emailed again after the session with the link to where to find that web page to find your slides and the homework. So no worries there. You can access that on your own time. I do want to take you back to that Mentimeter though before we wrap up, and get a sense of how much your confidence has changed. So remember at the very beginning of the session, we set out kind of 3 objectives of what we want to do today with you. We wanted to help you understand what the ISSB is. We wanted to help you understand how to use the ISSB standards. And we wanted to help you start to understand how to develop, or what activities you can do to start to develop a reporting strategy or enhance a current one. So we asked you how comfortable you were with those topics at the beginning. We'd love to know now how comfortable you are. So picking strongly disagree if you're not comfortable at all with these topics, or strongly agree if you are very confident, or anywhere in between. And it looks like a lot of you are now fairly confident with explaining the ISSB standards, but there's still a bit of struggle on using them, which is really good to know. That's where that homework can really come into play. So do take the time, especially if you're still kind of lagging on confidence on how to use the standards. Do start to go through those activities and think through how to move through your disclosure plan, applying these standards, and that will become much more clear because you'll see in practice how that works in your organization. So great. Thanks for those of you who filled that in. One more feedback point we'd love to get from you is, what part of this training did you like? We are always evolving and changing our training workshops, so we don't want to take out something that's working. So if there's anything that you particularly liked, please feel free to fill that in there. I'm going to leave that going, so you can enter that Menti at any point and type that in. But in the meantime, I'm going to take us back to the slides so that we can wrap up this session. First person said polls and homework, so that's great. We won't get rid of the polls, and we won't get rid of the homework. That's good to hear. Sometimes people don't get too excited about homework. Okay, again, you might have to switch the screen now to go back to the slides. Just use at the top of your screen. There's 2 tabs. Make sure you click on the one that says UNSSE screen. And that will bring your slides back for you. Great. So with that, I'm going to wrap us up. As a reminder for the homework, that's voluntary. You can do that if you wish, but we highly recommend it, especially since we didn't have the time to go through those last 2 activities together. But there's a number of other resources we want you to start looking into now as you continue your learning journey. The first of which is the IFRS Knowledge Hub. Jarlath and his team collate thousands and thousands of resources that are useful for report preparers and other stakeholders. So do come back again and again to this resource because it's constantly being updated. And you can access that in the slides or in that link in the chat that Landon just shared. Also, you can find on that Knowledge Hub or through the IFRS Foundation's sustainability side of their website, the standards. Now, you can't really get away with not reading the standards. This training does not replace the standards, but they're not actually that daunting. Jarlath often shows them, but we've got them here too, and they're not that big actually. You can get through them. Well, you can't actually see it on my screen, but you can get through them. We highly recommend, now that you have the fuller picture, that you can take a minute and read through those standards. Some other resources you might want to make use of is the IFC's Beyond the Balance Sheet. This is a really great repository of a number of resources. Again, the IFC works with global investors around the world, and they help them with a number of ESG related issues and enhancing their own disclosure. So you might want to check out that resource as well to look for different guidance documents and tools that you can use on your journey, especially related to corporate governance. And as we noted at the beginning, you can make use of the SSE toolkit. That's also in your slide deck, but we discussed that earlier today, so I won't go into that again. Now, the moment you've all been waiting for is how to get your certificate. So as I mentioned at the beginning, we just ask you to please fill in a short feedback survey in order to receive your certificate. So we'll share in the chat now, but you will also get emailed for those of you who participated, all of you who are here now. You will get an email from Zoom, an automated email, usually about 24 hours after the session. And in that email, look out for that link. So you have to read the email, but in it, it includes a link to the feedback survey. And once you fill in that feedback survey, it usually takes us about 3 to 5 days to get you that certificate. So just have, a few days patience with us so that we can make sure we get that certificate to you. And then I do recommend checking your junk folder, because these certificates come from a service called Simple Cert, and sometimes that's weeded out by your spam folder or your junk folder. So that's all you have to do. Just fill in that feedback survey. Give us a few moments of your time. It usually takes just 5 to 10 minutes, so it shouldn't take you too long. And before we wrap up today in our final minute, just a big thank you to everyone who made this training possible. First of all, thank you to the SSE official supporters. These are stock exchanges and other organizations that provide a voluntary financial contribution to the United Nations Sustainable Stock Exchanges Initiative, and it makes all of our training possible. So thank you so much to all of our supporters that support our mandate. And of course, we wouldn't be here today if it wasn't for Boursa Kuwait, who was hosting us. So thank you so much to Boursa Kuwait and Fatima and her team. And thanks to our partners, the IFC and the IFRS Foundation, for all of your support. Pleasure, as always, to be with you guys online. Lois, Jarlath, Bella, and Landon, thanks for supporting everyone in the chat. Wishing you all a great day, and thanks to all of the participants for hanging out with us for 3.5 hours. I hope you found it very useful, and we hope you continue to use all the resources that we shared with you as you continue your learning journey. Take care, everyone. Have a great afternoon.